the bear market and was out of work for 4 months. That was a very interesting period, because I believe you learn the most through adversity. I had about $20,000, which in those days was a lot of money, and I was going to trade. I found a real lunatic who had developed computer programs for trading commodities. At the time, he had to rent time on a monster machine to run programs that today you could do on any PC. He was using different moving averages, that sort of thing. I put some of my money in with him, and I lost most of it along with my dreams of glory. Having dissipated my capital, I decided I had to go back to work. I was in for a shock. Although I had been totally honest and forthright, I was tainted. Oh, aren't you the guy who wrote that report it didn't matter that I had been totally ethical and exonerated? People don't want to get involved with any controversy, even if it wasn't of your own making. A friend of mine helped me get a job at Edwards and Hanley, which, although it was a retail-oriented firm, had a group of analysts who became real stars. It was there that I met Bob Zollner, the managing partner of the firm. He was a great, great trader. He almost single-handedly kept the firm afloat in 1974 by shorting stocks and making money in the firm's capital account, while they were losing money on the operating side. He started his own hedge fund in 1976 and went on to become an extraordinary success. I always had a good nose as a securities analyst, and it has stood me in good stead. When I noticed that the head of research, who never went out to lunch, began going out to lunch regularly, I started interviewing for another job. So when the firm went bankrupt in fall 1975, I had another job lined up at Loeb Rhodes. In 19,761 met my wife-to-be, and she had a profound effect on me. She made me realize that my life was not a dress rehearsal. It was the real thing, and I had been screwing it up. Although I had steadily earned good salaries, I was still almost broke because I consistently lost money in the market. We got married in March 1978. By that time I was working at E. F. Hutton. Being married made going on business trips harder and harder. When you are 25, seeing friends from college in different cities around the country is very exciting, but when you get in your 30s, it gets real stale. My wife literally had to push me out the door when I had to go on these trips. I resented what I called the tack dances, which made you feel like a piece of meat. You meet with portfolio managers to give them your views on the stocks you follow, so that they will give commission business to your firm. On a typical trip, you might have 5 appointments in Houston, fly to San Antonio for dinner, and then fly to Dallas later that night to be ready for breakfast the next morning. I got sick of it. I wanted to have a family, but I felt that I wasn't able to handle it financially. I had resisted getting married because I was afraid of being tapped out. But at that point, I wondered whether it had been a self-fulfilling prophecy. People seem to know how to handle failure because they can produce it themselves. It almost becomes a negative cause and effect cycle whereby they produce it, they know how to handle it, and they wallow in it. By Midminus 19,781 had been a security analyst for 8 years, and it had become intolerable. I knew I had to do 100 something different. I always knew I wanted to work for myself, have no clients, and answer to no one. That, to me, was the ultimate goal. I had been brooding for years. Why wasn't I doing well when I was groomed to be successful? I decided it was now time to be successful. When a brokerage firm wants to hire you, they'll give you anything. Once you are there, they are far less responsive. So, when I was being romanced by Hutton, I asked for a quote machine in my office. I was the only securities analyst that had a quote machine. During my last year at Hutton, I started closing the door to my office so that I could watch the market. I talked to my friend Bob Zollner several times a day, and he taught me how to analyze market action. For example, when the market gets good news and goes down, it means the market is very weak. When it gets bad news and goes up, it means the market is healthy. During that year, I started taking trial subscriptions to a lot of different newsletters. I consider myself a synthesizer. I didn't necessarily create a new methodology, but I took a number of different methodologies and molded them into my own approach. I found a guy, Terry Laundrie, who lived in Nantucket and had an unorthodox approach called the magic forecast. He was an engineering graduate with a math background, and that appealed to me. His basic theory was that the market spent the same amount of time going up as going down, only the amplitude was different. In my experience, markets come down a lot quicker than they go up. Doesn't that contradict the theory the market movement before it goes down may be a distributive process? I call them MTOPs. The point you use to measure the time element is not the price high, but an oscillator high which precedes the price high. That, in fact, is a major cornerstone of his work. The theory had different properties that I learned, and it has been extremely helpful to me. For the record, what is the name of Laundrie's book? There is no book. He just extolled his theory through his various newsletters. He also had some pamphlets. Actually, it was kind of funny. After I mentioned him in a Barron's article, he got a lot of inquiries for his pamphlets. He is a little eccentric. His response was, "I don't have any copies available." He should have printed them and made some money. I developed and synthesized a number of indicators that I used to determine when the market was at a lower risk entry point. I focused on determining mathematical probabilities. Although occasionally there are situations where the market goes 3 standard deviations instead of 2, based on the likelihood that 98% of the moves will stop at 2 standard deviations, I'll take that bet any day of the week. And if I am wrong, I am going to use risk control and stop myself out X dollars away. That is the most critical element. Anyway, I subscribed to all these letters, developed a methodology, and traded like crazy. I mid-minus 19,790 $105,000 up to $140,000 in just 2 years. When did you turn from a loser to a winner? When I was able to separate my ego needs from making money. When I was able to accept being wrong. Before, admitting I was wrong was more upsetting than losing the money. I used to try to will things to happen. I figured it out, therefore it can't be wrong. When I became a winner, I said, I figured it out, but if I'm wrong, I'm betting the hell out, because I want to save my money and go on to the next trade. By living the philosophy that my winners are always in front of me, it is not so painful to take a loss. If I make a mistake, so what? Did you make a complete transition from fundamental to technical analysis? Absolutely. I always laugh at people who say, "I've never met a rich technician." I love that. It is such an arrogant, nonsensical response. I used fundamentals for 9 years and got rich as a technician. But you are still doing fundamental analysis as an analyst, yes, to earn a salary. But my wife said to me, "Go out on your own. You're 34 and you've always wanted to work for yourself. The worst that can happen is that you 11 go back to doing what you were doing before." I always pictured myself as being brave, courageous, and strong, but when it came time to take the chance, I was scared out of my mind. I had $140,000, of which about $30,000 was tied up in tax and deals, and $92,500 was used to pay for a seat on the American Stock Exchange. That left me with about $20,000 when I went on the floor as a market maker. I borrowed $50,000 from my in-laws, which gave me $70,000 of working capital. I started off losing in my first 2 days in the business. I got involved in Mesa Petroleum options because Zollner, whom I profoundly respected, thought they were significantly undervalued. I called him the second day from the floor. "Are you sure you are right? I must have had a grand total of 10 options." I was down $1,800 and dying. I was petrified because, in my mind, I was down almost 10%, since I didn't consider my in-laws' money part of my own working capital. The third day Mesa options started going up and I never looked back. After the first 4 months I was ahead by $100,000. The next year I earned $600,000. After 19,811 never earned less than seven figures. I remember talking to a good friend of mine in 1979 and saying, "I don't think anybody can make $40,000 a month trading options. Now I can do that in a day without a problem." You were doing very well on the floor. Why did you leave? It was very slow during lunchtime in those years. I used to go to an upstairs office to eat my lunch. While I was at my desk eating a sandwich, I would do my charts and look for different ideas. I came to realize that I could see much more sitting at the desk looking at a machine than being at a post trading an option. On the floor, the specialists chose the symbols they wanted to keep on the "machines" because they paid the rent on them. So you always had to run around to find what you wanted to see. I felt much more comfortable upstairs. About a year and a half later, after I started earning a lot of money, the floor wasn't big enough. There was a much bigger arena to play in. Another reason for my move was the fact that in 1981 a change in the tax laws made it more lucrative to trade futures than stocks and options. In my futures trading I didn't try to make two one year, four the next, eight the next, etc. I didn't earn 101 significantly more in my futures trading in 1987 than I did in 1982 because I used my profits to invest in real estate and other things to enhance the quality of my life. I was broke in the 1970s, and I never wanted to be broke again. My philosophy was that if you make money every month, nothing bad is going to happen to you. So you won't be the richest person. You'll never be the richest person anyway. What difference does it make? I'm proud of my futures trading because I took $40,000 and ran it up to about $20 million with never more than a 3% drawdown. Did you continue trading stocks during this period? Yes, but with a different mentality. I traded stocks from a little longer time horizon. I don't feel the same pressure when I own 100,000 shares of stock as when I own 100S and PS. Will you trade stocks as readily from the short side as the long side? No. I find it harder to trade stocks from the short side. Because of the uptick rule, no. It is just easier to short the S&P because you get so much more bang for the buck. Also, I hate the specialist system. They are always trying to con you to death. I'll give you my view on specialists. Never in my life have I met a less talented group of people who make a disproportionately large amount of money relative to their skills. Having the specialist book is the most extraordinary advantage one could ever ask for. In normal markets, the specialists can always define their risk. If they have a bid for 20,000 down, they can buy the stock, knowing they can always get out lower. So they are protected. I always tell my friends to have their daughters marry the son of a specialist. I can't stand most established institutions. I have a me against them mentality, which I believe helps me be a better, more aggressive trader. It helps as long as I maintain an intellectual bias in my work and discipline in money management. What was your experience during the week of the October 19 stock crash? I came in long. I have thought about it, and I would do the same thing again. Why? Because on October 16, the market fell 108 points, which at the time was the biggest one-day point decline in the history of the stock exchange. It looked climactic to me, and I thought that was a buying opportunity. The only problem was that it was a Friday. Usually a down Friday is followed by a down Monday. I don't think Monday would have been nearly as bad as it was if Treasury Secretary James Baker had not started verbally bludgeoning the Germans about interest rates over the weekend. He was so belligerent. Once I heard Baker, I knew I was dead. So you knew that you were in trouble over the weekend, yes. Also, Marty Zweig, who is a friend of mine, was on Wall Street Week on Friday evening talking about a possible depression. I called Marty the next day, and he said he thought there was another 500 points risk in the market. Of course, he didn't know it was going to happen in one day. What made him so bearish at the time, I think his monetary indicators were terribly negative. Remember, the bonds were sinking rapidly at the time. What happened? That Monday, when did you get up the high in the ass? And P on Monday was 269.1, liquidated my long position at 260. 70.1 was real proud of that because it is very hard to pull the trigger on a loser. I just dumped everything. I think I was long 40 contracts coming into that day, and I lost $315,000. One of the most suicidal tilings you can do in trading is to keep adding to a losing position. Had I done that, I could have lost $5 million that day. It was painful, and I was bleeding, but I honored my risk points and bit the bullet. That's another example where my marine training came into play. They teach you never to freeze when you are under attack. One of the tactics in the Marine Corps officer's manual is either go forward or backward. Don't just sit there if you are getting the hell beat out of you. Even retreating is offensive because you are still doing something. It is the same thing in the market. The most important thing is to keep enough powder to make your comeback. I did real well after October 19. In fact, 1987 was my most profitable year. You liquidated your long position very well on October 19. Did you think about actually going short? I thought about it. But I said to myself, now is not the time to worry about making money. It is the time to worry about keeping what you have made. Whenever there is a really rough period, I try to play defense, defense, defense. I believe in protecting what you have. The day of the crash, one got out of most of my positions and protected my family. Then at 130p, and with the Dow down 275 points, I went to my safe deposit box and took my gold out. Half an hour later, I went to another bank and started writing checks to get my cash out. I started buying treasury bills and preparing for the worst. I had never seen anything like what was going on. You were seriously worried about the banks going under. Why not? The stories I heard subsequently from people on the operations side of the business would have stopped the hearts of the public if they had known what was going on. The banks weren't meeting any of the calls at the brokerage firms. On Tuesday morning, we were within hours of the whole thing totally collapsing. So my caution was well advised. I think my fear of a depression is related to my father graduating college in 1929. If you talk to people who got out of college at that time, it is as though a 10-year period is missing from their lives. There was just nothing substantial going on in this country. That always stuck with me because I feared it so much. I think that is one of the reasons why I don't try to increase my earnings geometrically. On the day of the crash, when I looked at my son in 100 to his crib, I thought, I don't want him ever to ask me, Dad, why didn't you do everything you could have done? When did you start trading again? Wednesday of that week. It was funny because I started out trading only 1 or 2 S and P contracts at a time. The S and P was trading in full point increments equivalent to $500 per contract compared to $25 for a minimum tick, and I didn't know how to handicap what was going on. From past experiences, I knew we were in some sort of opportunity period, but they were rewriting the rail book. My attitude is never risk your family's security. I didn't need to make any more money at that point. On Wednesday, the market got up to an area where I thought it should be shorted. I ended Wednesday short 12S and P contracts, which for me was a minuscule position. That night, Bob Pritchard, editor of the Elliott Wave Theorist, a widely followed advisory letter, put out a negative hotline message. The next morning, the market was under tremendous pressure, partially because of that recommendation, but mainly because one of the biggest fund managers in the country was trying to liquidate a monster long position. It has been stated that he lost $800 million during that period. I called the S&P pit just before the opening that morning, and my clerk said, "Decembers are offered at 230, offered at 220, offered at 210, trading at 200 even." I yelled, "Cover." I made $250,000 on 12 contracts. It was one of the most memorable trades of my life. What are your thoughts about program trading? See Appendix 1 for definition. I hate it. There used to be a natural ebb and flow in the market, but program trading killed it. Those firms doing program trading wield extraordinary power to move the market, and the locals have simply become accomplices. I'm not just paranoid, because I've adjusted to it and been successful, but I hate it. Some people say that all this criticism of program trading is a bunch of nonsense. Well, they are idiots. No, some of them are very intelligent people. No, they are idiots. I can prove to any one of them that they are idiots. How do you prove it? There is something I would like the regulators to investigate. The market closes near the high or low of the day much more frequently than it used to. During the last 2 years, the market has closed within 2% of the high or low of the day, about 20% of the time. Mathematically, that type of distribution is impossible by chance. You talk about program trading as if it is immoral. What is unethical about trading stocks against futures, because the program traders also have the other side of the equation to do. You have the so-called Chinese wall in investment banking, where they don't want the arbitrageurs and investment bankers on the same floor for fear they might talk to each other. Well, I would like the SEC to explain to me how they can allow agency program traders sitting alongside principal traders for the firm's own account. Their example introduces an element of front-running which obscures the basic question. What I am trying to get at is what is immoral about buying stock and selling futures or the reverse trade because prices in the two markets are out of line, because I've seen situations in which a firm has information about a debt equity swap a day ahead of time. For example, when the state of New Jersey sold $2 billion worth of stock and moved it into the bonds, this firm knew about it the day before. Since they knew they were going to be selling $2 billion worth of stock the next day from 400 to 415, they sold thousands of futures contracts to set up the trade. It stinks. The example you just gave is a case of trading on inside information, B, front-running, and C, an outright trade. It is not a program trade. Let me give you an example. Let's say a trading firm has a computer program that signals when stocks are overpriced or underpriced relative to futures, and they are not doing any customer business. Let me give you an example first. If these brokerage firms need an 80-cent discount to take off a customer program, they will take off their own position at a 50-cent discount. They have the edge and can run in front of their clients because their transaction costs are lower. They are not paying commissions to themselves. I keep trying to separate these things out. Let's take an example where there is no front-running or customer business, just somebody trading their own money, trying to take out an arbitrage profit. If that is their methodology, why is it any worse than your methodology? Because it is a dumb game. Anybody who puts on a basket of stocks to earn 80 basis points above the T-bill yield is an idiot. They are the same idiots I tried to get away from when I left security analysis. Who the hell needs to earn 80 basis points over treasury bills? The brokerage firms sell them this bill of goods because it is a way of creating more order flow, which on Wall Street today has become the ultimate power. Are you saying program trading is wrong? Even for some entity that is not trading customer money? I grew up being a security analyst, analyzing things and buying something for value. Trading stocks against stock index futures, in and out, serves no useful purpose. They are buying and selling, and you are buying and selling. What's the difference? I am trying to earn infinity when I trade. What makes that style any more right than the style which is trying to arbitrage the market? I guess it is their constitutional right, and they are able to do it. But there are some incredible abuses as a consequence. I scream at the kids who work for these brokerage firms. You SOBs have no integrity, no ethics. You know what will happen. You are going to kill the game. Now they are swearing at me. When they stopped doing 103 proprietary program trading, they said, "Are you happy you got your wish?" I said, "No, it is not quite finished yet." I didn't tell them the conclusion, which comes when they are no longer earning $300,000 or more a year, and they find out what they are really worth when they are hitting the bricks and can't get a job for $50,000. Then it will have come full circle. Speaking of circles, we seem to be moving in one on this subject. Let's go on. What stands out as your most dramatic trading experience, the most gut-wrenching time, was in November 1982. I had a much smaller net worth then, and I took a $600,000 loss in one day. What happened? It was election day, and the Republicans did much better than expected in the congressional races. The market ran up 43 points, which at that time was one of the largest point advances in history. I was short, and like an imbecile, I sold more with the S&P locked at the 500-point limit against me and less than an hour left in the trading session. My wife, who was working with me at the time, was out that day. The next day she came into work, and every 10 minutes she would say, "Get smaller, get smaller." I kept taking losses, just getting out of the position. Whenever you get hit, you are very upset emotionally. Most traders try to make it back immediately. They try to play bigger. Whenever you try to get all your losses back at once, you are most often doomed to fail. That is true in everything: investments, trading, gambling. I learned from the crap table at Las Vegas to keep only X dollars in my pocket and never to have any credit, because the worst thing you can do is to send good money after bad. If you can physically remove yourself from the premises, which is the same thing in futures trading as getting flat, you can see things in a whole different perspective. After a devastating loss, I always play very small and try to get black ink, black ink. It's not how much money I make, but just getting my rhythm and confidence back. I shrink my size totally to a fifth or a tenth of the position that I trade normally, and it works. I think I ended up losing only $57,000 in November 1982 after taking a $600,000 hit on November 4. Is there any trading mistake that you could isolate as responsible for that election day 1982 loss adding to shorts when the futures market is already locked limit against you and the cash market looks like it is 200 points higher? Is pretty stupid. When you look back, do you say, "Why did I do it?" I think because I had huge gains the month before. I've always had my biggest setbacks after my biggest victories. I was careless. Do you still make trading mistakes? By that, I mean deviations from trading principles you consider valid, not losing trades. You always make trading mistakes. I made one just recently, a terrible mistake. I was short the S&P and short the bonds, and I got nervous because the bonds moved above their moving average. However, T-bills had not followed suit. One of my rules is not to have a position when my moving averages in T-bills and bonds diverge, that is, when one moving average is above the price and the other below, because interest rates can't move very far until one confirms the movement of the other. According to my rails, I should have moved my bond position from short to flat. Instead, I reversed from short to long. I paid dearly for that mistake. Whereas I had lost only about $20,000 on my original short position, the next day I had a six-figure loss, my largest loss of the year. The great thing about being a trader is that you can always do a much better job. No matter how successful you are, you know how many times you screw up. Most people in most careers are busy trying to cover up their mistakes. As a trader, you are forced to confront your mistakes because the numbers don't lie. From time to time, you have alluded to your trading rules. Can you list them? Reading from a list and extemporizing, I always check my charts and the moving averages prior to taking a position. Is the price above or below the moving average? That works better than any tool I have. I try not to go against the moving averages. It is self-destructive. Has a stock held above its most recent low when the market has penetrated its most recent low? If so, that stock is much healthier than the market. Those are the types of divergences I always look for. Before putting on a position, always ask, do I really want to have this position after a successful period? Take a day off as a reward. I found it difficult to sustain excellent trading for more than 2 weeks at a time. I've had periods where I can be profitable for 12 days in a row, but eventually you just get battle fatigued. So, after a strong run of profits, I try to play smaller rather than larger. My biggest losses have always followed my largest profits. This next rail is a major problem for me. I'm always trying not to break it. The rail bottom fishing is one of the most expensive forms of gambling. It's okay to break this rail on occasion if you have sufficient justification. For example, today I bought the S and PS when they were down sharply. 2 weeks ago, I had written down the number 248.45 as the best entry for the S&P. The low today was 248.50. Consequently, I was able to buy into weakness today and make a good deal of money. I had a plan, I carried it out, and it worked. It doesn't always work. It was risky, but I wasn't pyramiding wildly into it, and I knew how much I was risking. That brings me to my next rule before taking a position. Always know the amount you are willing to lose. Know your uncle point and honor it. I have a pain threshold, and if I reach that point, I must get out. When T-bonds and T-bills differ in respect to their individual relationship between price and the moving average, one above the moving average, the other below, have no position until one confirms the direction of the other. Generally speaking, a price above its moving average implies a price uptrend, while the reverse case implies a price downtrend. 104 then, the last words I have at the bottom of the page are work, work, and more work. Is there anything to add to that list? The most important thing is money management. Money management. Money management. Anybody who is successful will tell you the same thing. The one area that I am constantly trying to improve on is to let my gains run. I'm not able to do that well. I'm always working on it. To my dying day, I'll probably still be working on it. Is that because you do something wrong? I just love to take profits. I hear music when the cash register rings. The irony is, how can I be willing to risk 400 points on the downside and only take 200 points of a 1,000-point move on the upside? On the risk side, you have a method, a plan. Have you experimented with trying to use similar discipline on the profit side? Yes, but I haven't been able to perfect it. I have had varying degrees of success, but it is my greatest criticism of myself. Why the difficulty in this area? I think it all relates to my fears of some cataclysmic event. I'm like W.C. Fields. I have several bank accounts and a few safe deposit boxes with gold and cash. I am extremely well diversified. My thought process is that if I screw up in one place, I'll always have a life preserver someplace else. Any other rules you can think of? Yes. If you're ever very nervous about a position overnight, and especially over a weekend, and you're able to get out at a much better price than you thought possible when the market trades, you're usually better off staying with the position. For example, the other day I was short the S&P and got nervous because the bond market was very strong on the night session. The next morning, the stock market was virtually unchanged. I was so relieved that I could get out without a loss, I covered my position. That was a mistake. A little later that day, the S&P collapsed. When your worst fears aren't realized, you probably should increase your position. What has been your worst drawdown, percentage-wise? My records were just evaluated for a money management deal. Over my entire career as a full-time trader, based on month-end data, my biggest drawdown was 3%. I had my worst 2 months around the birth of my two children because I was worried about whether I was going to get the tennis ball in the right place in Lama's class. My philosophy has always been to try to be profitable every single month. I even try to be profitable every single day. And I've had some extraordinary runs. Over 90% of my months have been profitable. I'm particularly proud of the fact that in virtually every year I didn't have a losing month before April. I probably don't make as much money as I could because of that, but I'm more concerned about controlling the downside. You start off every year with a clean slate. That's my philosophy. January 1, I'm poor. Do you trade smaller in January? Not necessarily. It is just that my attention is greater. Do you take your losses more quickly in January? No, I always take my losses quickly. That is probably the key to my success. You can always put the trade back on, but if you go flat, you see things differently. Greater clarity, much greater clarity, because the pressure you feel when you are in a position that is not working puts you in a catatonic state. Getting back to managed money, I wonder, after years of making plenty of money trading on your own, what possible motive could you have for bothering with managing other people's money? I felt that I was getting a little stale, and this presents a whole new challenge. Also, after October 19,871 realized that downside risk can't be adequately measured. The way to get more personal leverage is with an outside pool of money. How much money are you going to be managing? I don't want to be specific about the amount, but I'm only taking on one or two large pools of money. I don't want to deal with multiple investors, even though I'm certain I could raise a great deal more money if I went with a public underwriting. The more people you have involved, the more potential headaches. For example, when I met a large fund manager, he asked me how many employees I had. I told him none. He told me he had 70. When he wants to quit, it will be more difficult because he'll have their lives in his hands. I don't want that kind of pressure. You seem rather isolated here. Do you like working alone? It took me several years to be able to accept working alone. I used to go to a downtown office because a lot of my friends were there. But as time passed and fewer of those people were still there, the attraction diminished significantly. Now I have half a dozen people I talk to on the phone daily. I've taught my methodologies to a number of them, and they have methodologies of their own. Have you ever tried training people to be traders working for you? I hired 4 people, but nobody lasted. They all became intimidated. I tried to clone myself, and it didn't work. 105, I taught them all my methodologies, but learning the intellectual side is only part of it. You can't teach them your stomach. Why do most traders lose money because they would rather lose money than admit they are wrong? What is the ultimate rationalization of a trader in a losing position? I'll get out when I'm even. Why is getting out even so important? Because it protects the ego. I became a winning trader when I was able to say, to hell with my ego, making money is more important. What do you tell people who seek your advice? I always try to encourage people that are thinking of going into this business for themselves. I tell them, think that you might become more successful than you ever dreamt, because that's what happened to me. I have the freedom I'd always wanted, both financially and structurally. I can go on vacation at any moment. I live in West Hampton Beach half of the year and in New York the other half. I have a wonderful lifestyle. My kids think all fathers work at home. What is the best advice you can give to the ordinary guy trying to become a better trader? Learn to take losses. The most important thing in making money is not letting your losses get out of hand. Also, don't increase your position size until you have doubled or tripled your capital. Most people make the mistake of increasing their bets as soon as they start making money. That is a quick way to get wiped out. Marty Schwartz's story should encourage those whose initial attempts at trading have met with failure. Here is a trader who was unsuccessful over a 10-year period, managing to lose enough money to keep himself near broke, despite consistently earning good salaries. Yet, Schwartz was eventually able to turn things around and become one of the world's best traders. How did he do it? There were two essential elements. First, he found a methodology that worked for him. Throughout his losing years, Schwartz used fundamental analysis to determine his trades. It was not until he immersed himself in technical analysis that he became successful. The point here is not that technical analysis is better than fundamental analysis, but rather that technical analysis was the methodology that was right for him. Some of the other traders interviewed in this book, such as James Rogers, have been very successful using fundamental analysis to the complete exclusion of technical analysis. The key lesson is that each trader must find his or her own best approach. The second element behind Schwartz's transition to success was a change in attitude. As he describes it, he became successful when his desire to win took precedence over his desire to be right. Risk control is an essential element of Schwartz's trading style, as attested to by his incredibly low drawdowns. He achieves this risk control by always knowing his uncle point on any trade. No doubt, his approach of sharply reducing position size after large losses as well as extended winning streaks contributes heavily to his success. The rationale for reducing position size after a destabilizing loss is apparent. However, the reason for taking the same action after a winning streak deserves further elaboration. As Schwartz explains it, he has always experienced his biggest losses after his biggest gains. I suspect this is true for the majority of traders. Winning streaks lead to complacency, and complacency leads to sloppy trading. Most traders cite similar rules such as discipline and hard work as the reasons for their success. Therefore, it is always a treat when a top trader provides a rule that is unique and rings true. I was fascinated with Schwartz's observation about maintaining a position that you are worried about when the market action doesn't justify your fears. The implicit concept is that if the market is letting you off the hook easily on a position for which there was a basis for fear, such as a fundamental development adverse to the position or a technical breakout in the opposite direction, there must be strong underlying forces in favor of the direction of the original position. 106, 107 Part Roman 3, a little bit of everything. 108 James B. Rogers, Jr. buying value and selling hysteria. Jim Rogers began trading the stock market with a paltry $600 in 1968. In 1973, he formed the Quantum Fund with partner George Soros. The Quantum Fund proved to be one of the best performing hedge funds, and in 1980, having amassed a small fortune, Rogers retired. Retired is the word Rogers uses to describe the management of his personal portfolio, an endeavor that requires considerable ongoing research. His retirement also includes teaching investment courses at the Columbia University Graduate School of Business. I was eager to interview Rogers because of his stellar reputation as one of the shrewdest investors of our time, and because his comments on television financial interview shows and in the print media always seemed to strike a note of common sense with rare clarity. Since I did not know Rogers, I sent him a letter requesting an interview, explaining that I was working on a book on great traders. I included a copy of my previous book on the futures markets, which I inscribed with a quotation from Voltaire that I deemed particularly appropriate. Common sense is not so common. Rogers called a few days later to thank me for the book and to indicate his willingness to participate. However, he cautioned, "I am probably not the person you want to interview. I often hold positions for many years. Furthermore, I'm probably one of the world's worst traders. I never get in at the right time." He was referring to the distinction I had made in my letter, indicating that I was interested in great traders rather than great investors. As I use the term, a trader would be primarily concerned with which direction the stock market was heading, while an investor would concentrate on selecting stocks with the best chance of outperforming the market overall. In other words, the investor was always long, while the trader might be long or short. I explained my use of these terms to Rogers and stressed that he was indeed the type of person I wished to interview. I arrived at Rogers' home, a baronial, eclectically furnished townhouse, on a fall-like spring afternoon. The atmosphere seemed more reminiscent of a comfortable English manor than a home in New York City. In fact, if my only exposure to New York City was that afternoon's conversation with Rogers in his antique-filled sitting-room with its pleasant views of the Hudson, I would conclude that New York City was an eminently peaceful place to live. After greeting me, Rogers immediately stated, "I still think you have the wrong man." Once again, he was referring to the fact that he did not consider himself to be a trader. This is the note on which the following interview begins. "As I told you in our phone conversation, I don't consider myself a trader. I remember when I went to buy German stocks in 19,821 said to the broker, 'I want you to buy me X, Y, and Z stocks.' The broker, who didn't know me, asked, 'What do I do next?' I said, 'You buy the stocks and send me the confirmations.' He asked, 'Do you want me to send you some research?' I said, 'Please don't do that.' He asked, 'Do you want me to send you opinions?' I said, 'No, no, don't.' He asked, 'Do you want me to call you with prices?' I said, 'No, don't even give me prices, because if you do, once I see that these stocks have doubled and tripled, I might be tempted to sell them. I plan to own German stocks for at least 3 years, because I think you are about to have the biggest bull market you've had in 2 or 3 generations." Needless to say, the broker was dumbfounded. He thought I was a madman. Now, I don't consider that trading. It was determining that there was about to be a major change in a market, and taking a position. By the way, I got that one right. I bought the German stocks at the end of 1982 and sold them out in late 1985 and early 1986. What made you so bullish on Germany at that time? The bull market had started here in August 1982. More important, Germany had not had any kind of bull market since the previous all-time high in 1961, 21 years earlier. The German market had crumbled in 1962 and had essentially gone sideways since then. In the meantime, the German economy had boomed, so there was basic value there. Whenever I buy or sell something, I always tried to make sure I'm not going to lose any money first. If there is very good value, Then I'm probably not going to lose much money even if I'm wrong. But you could have bought that market 10 years earlier on the same theory. That's absolutely right. You could have bought it in 1971 for exactly those reasons and watched German stocks sit for 10 years while we had a major bull market in the U.S. But this time there was a catalyst. You always need a catalyst to make big things happen. At the time, the catalyst was the upcoming German elections. I figured the socialists were going to be thrown out, and I knew that the opposition party, the Christian Democrats, had a platform designed to encourage investment. My basic assessment was that if the conservative Christian Democrats won the election after having been out of power for so many years, they were going to make major changes. I also knew that many German companies were holding back from investing in capital equipment and expansion in 1982 in anticipation of a conservative victory. Therefore, if the conservatives did win, there would be a real explosion of pent-up capital investment. Was the election a toss-up at the time? Not in my mind. I mean in terms of the polls. I guess so, because when the conservatives did win, the market exploded FLMT same day. What if they had lost? I still didn't think I would have lost any meaningful money for the reasons I mentioned before. I had every anticipation that there was going to be a major change and that the bull market would last for 2, 3, or 4 years. It sounds like you have a great deal of conviction when you put on a trade. Yes, I usually do. Otherwise, I don't bother doing it. One of the best rails anybody can learn about investing is to do nothing, absolutely nothing, unless there is something to do. Most people, not that I'm better than most people, always have to be playing. They always have to be doing something. They make a big play and say, "Boy, M109 I smart, I just tripled my money." Then they rash out and have to do something else with that money. They can't just sit there and wait for something new to develop. Do you always wait for a situation to line up in your favor? Don't you ever say, "I think this market is probably going to go up, so I'll give it a shot." What you just described is a very fast way to the poorhouse. I just wait until there is money lying in the corner, and all I have to do is go over there and pick it up. I do nothing in the meantime. Even people who lose money in the market say, "I just lost my money. Now I have to do something to make it back." No, you don't. You should sit there until you find something. Trade as little as possible. That is why I don't think of myself as a trader. I think of myself as someone who waits for something to come along. I wait for a situation that is like the proverbial shooting fish in a barrel. Are all your trades fundamentally oriented? Yes. Occasionally, however, the Commodity Research Bureau charts will provide a catalyst. Sometimes the chart for a market will show an incredible spike either up or down. You will see hysteria in the charts. When I see hysteria, I usually like to take a look to see if I shouldn't be going the other way. Can you think of any examples? Yes. 2 years ago, I went short soybeans after they had gone straight up to $9.60. The reason I remember it so vividly is because that same evening I went to dinner with a group of traders, one of whom was talking about all the reasons why he had bought soybeans. I said, "I really can't tell you why all the bullish arguments are wrong. All I know is that I'm shorting hysteria." How do you pick the time to go against the hysteria? I wait until the market starts moving in gaps. In the midst of it all, or do you wait for some sign of an end to the move? For example, a reversal day? No, I don't know about reversal days. That brings to mind a classic example of hysteria. In late 1979, early 1980, the gold market witnessed an incredible accelerated advance. Did you go short? That market, yes. I sold gold at $675. That was almost $200 too early. I told you I'm not a good trader. I'm nearly always too early, but it was only about 4 days before the top. I didn't say you were way off time-wise, but price-wise it must have been a pretty scary ride. When you do a trade like that, isn't there a point where you have second thoughts? Yes, when it goes to $676 he laughs. But you stayed with the trade, yes, in that case, because it was chaos. It was something that couldn't last. It was the gold market's dying gasp. Was that a matter of recognizing the fingerprint of a market in its final blow-off, or was it a matter of gold being overpriced both? Gold was overpriced, but basically it was, I like your terminology, the fingerprint of hysteria. Just about every time you go against panic, you will be right if you can stick it out. So when you see panic, do you automatically go against it? The panic, the hysteria, in and of itself, is only a catalyst to make me look to see what is going on. It doesn't mean I'm going to do anything. In the case of the early 1980 gold market, I had a view of the world that was bearish for gold. Volcker had just become the Federal Reserve chairman a few months earlier and said that we were going to beat inflation. I believed he meant it. I also happened to be bearish on oil at the time, and I knew that if oil went down, gold would go down as well. Was that because you thought gold and oil should move together, or because you thought the rest of the world believed that at that time? Everybody in the world believed that. But did you believe that the relationship was true? I knew that it was not true. The reason I asked is that I have always felt that the relationship between gold and oil was a coincidental correlation. Yes, that was all it was. For one very short period of time, gold and oil moved together. Does that mean you will sometimes do a trade based on a relationship you know doesn't really make any sense, simply because you think that the rest of the world believes it rarely? I usually like to look at what I think is the fact, the truth. The main item then was that I thought Volcker meant it when he said he was going to break the back of inflation. The fact that oil was ready to go down anyway was just the kicker. Actually, the decisive step came in October 1979 when the Fed changed its policy from controlling interest rates to controlling money supply growth. Yet the gold market apparently didn't believe it, 110, because it went up for several months after that point. In situations like that, are the markets too wound up in their hysteria to pay attention to changing fundamentals? Absolutely. It is how sometimes something important will happen, and the market will keep going despite that. Now, I am experienced enough to know that just because I see something doesn't mean that everyone sees it. A lot of people are going to keep buying or selling just because that has been the thing to do. So, just because the market doesn't respond to some important news, such as the October 1979 change in Fed policy, doesn't mean that it isn't important. All the better. If the market keeps going the way it shouldn't go, especially if it is a hysterical blow-off, then you know an opportunity will present itself. Can you think of a more recent example? Yes, October 1987. October 19 is my birthday, by the way. At the end of 1986 and the beginning of 19,000, 871 had predicted that we would have one more big move up in the stock market and then witness the worst bear market since 1937. But I didn't know it was going to happen on my birthday. It was the best birthday present I ever had. Did you have any idea that the break could be as large as it was? When John Train interviewed me in January 19,000, 871 told him somewhere along the way the market is going to go down 300 points in one day. He looked at me as though I were a madman. I envisioned that the Dow would be around 3,000 and 300 points would only be 10%. In 1929, the market went down 12% in one day. 10% in one day was not such a big move given the kind of markets we were having then. The market had already seen a number of 34 and 5% days. So I said, why can't the market go down 300 points in a day? Little did I know it would be 508 points. Why did you pick 1937 as a comparison in your prediction for a stock market collapse? Because in 1937, the Dow went down 49% in 6 months. What I was trying to say was that we were going to have a major, fast, deep, horrible collapse, as opposed to, say, 1973 minus 1974, when the market went down 50%, but it took 2 years. Why did you use 1937 as an analogy as opposed to 1929 minus 1930? Because 1929 minus 1930 went on to be a major depression. I knew we were going to have a bear market caused by a major financial collapse. I was not convinced we were going to have a depression. I was differentiating between a financial and economic collapse. Why were you expecting a financial collapse? It was the atmosphere. Money was flooding the world. Every stock market in the world was at an all-time high. You had all these stories of young guys, 3 years out of school, making $500,000 a year. That is not reality. Whenever you see that in a market, you are near a top. So I went into the summer position for a collapse. Were you short stocks or long puts? I was short stocks and short calls. I don't buy options. Buying options is another fast way to the poorhouse. Someone did a study for the SEC and discovered that 90% of all options expire as losses. Well, I figured out that if 90% of all long option positions lose money, that meant that 90% of all short option positions make money. If I want to use options to be bearish, I sell calls. When did you cover your positions? During the week of October 19. If you remember, by that time, everybody thought that the financial structure of America was over. Did you cover then because we had hysteria going the other way? That is exactly right. That week was a textbook case of hysteria. Under those kind of conditions, if you are still solvent, you have to step in there and go against it. Maybe that was going to be the one time it was the end of the world, and I would have been wiped out too. But 95% of the time when you go against that kind of hysteria, you are going to make money. Between October 1987 and January 19,881 didn't have any shorts. That was one of the few times in my whole life that I didn't have any shorts. Whether I am bullish or bearish, I've always tried to have both long and short positions just in case I'm wrong. Even in the best of times, there is always somebody fouling up, and even in the worst of times, there is somebody doing well. Are you implying that after the collapse, you couldn't find any stocks you wanted to be short? I thought that if I were right and the world wasn't coming to an end right away, everything was going to go up, including those stocks that I knew fundamentally were coming apart at the seams. In January 1988, I started putting a couple of shorts back on, and even though I am losing money on one of those shorts, I am happy to do it because I feel more comfortable having the protection of some short positions. A lot of people blame the October 1987 break on program trading. Do you consider that scapegoatism? Absolutely. The people who blame it on that do not understand the market. Politicians and people who lose money always look for scapegoats. In 1929, they blamed the crash on short sellers and margin requirements. There were lots of good reasons why the stock market went down. What they should focus on is why there were sellers on October 19, but no buyers. I remember why I became even more bearish on the weekend before October 19. The week before, Federal Reserve Chairman Alan Greenspan announced that the balance of trade was getting much better and things were under control. 2 days later, the balance of trade figures came out, and they were the worst in the history of the 111 world. Right away I said, this guy is either a fool or a liar. He doesn't have any idea what is going on. Then on the weekend before October 19, you had Treasury Secretary Baker telling the world we were going to stick it to the Germans by letting the dollar go, because the Germans weren't loosening monetary and fiscal policy as Baker had demanded. It looked like the trade wars of the 1930s all over again. I was in a panic and I was already short. I called Singapore that Sunday night to add to my shorts. Singapore opens earlier than we do. So all those guys who came in on Monday to sell had very, very good reasons to sell, and there were no buyers around. There were no buyers because there was no reason for people to buy. Even the buyers were scared and bearish that Monday. Are you saying the crash was caused by Greenspan and Baker? There were a lot of causes. Greenspan, Baker, the fact that money was tight, the steady worsening of the balance of trade, and you had a market that had spiked up to 2,700 6 weeks earlier. If you check, you will see that during 1987, while the S&P and the Dow were going up, the rest of the market was quietly eroding away. In December 19,861 shorted the financial stocks, and throughout 19,871 didn't lose any money, even though the Dow and the S&P were going through the roof. Were there any times you faded hysteria and lost? Yes. One of my greatest lessons happened in my early days and taught me about bear markets. In January 1970, a time when I still bought options, I took all the money I had, which wasn't very much, and bought puts. In May 1970, the market caved in, and the day the market hit bottom, I sold my puts. I had tripled my money. I was a genius. I'm going to be the next Bernard Baruch, I said to myself. My plan then was to wait for the market to rally and this time to sell short instead of buying puts so that I would make money faster. Sure enough, the market rallied and I took everything I had and went short. Needless to say, 2 months later I was completely wiped out because I didn't know what I was doing. One of the stocks I had shorted was Memorex. I sold Memorex at 48. In those days, I didn't have the staying power psychologically, emotionally, and most important, financially. I ended up covering my shorts at 72. Memorex eventually went to about 96 and then went straight down to 2. I was dead right, absolutely flat out, perfectly right to short. That stock at 48.1 just ended up getting completely wiped out. The market didn't care that I was dead right. That is one of the reasons that I now know about hysteria. What did you learn from that particular experience, that the market is going to go higher than I think it can and lower than I think it will? I had a tendency to think that if I knew something, everybody knew it. I would just read things in the paper. I didn't have any inside information. What I now know is that they don't know what I know. Most people don't have the foresight to look 6 months, 1 year, or 2 years out. The Memorex experience taught me that anything can happen in the stock market, because there are a lot of people in the market who don't understand what is going on. Are you looking for a very pronounced bear market beyond what we have already seen? Yes. Eventually, I expect the market to break the October 1987 low. Do you expect a very deep recession as well? Right now, April 1988, I'm still looking mainly for a financial collapse. However, the politicians may foul it up and turn it into an economic collapse. Can we get a financial collapse without actually having a very serious recession? Sure. It has happened lots of times. That is why I used 1937 as an example before. I don't expect the economy to collapse because as the dollar keeps getting weaker, which is what I expect many parts of the American economy will do, well, steel, agriculture, textiles, mining. So even if the stock market falls below the October low, you can still see the economy doing well, absolutely, unless the politicians foul it up by doing what? Raising taxes, tariffs, protectionism. There are lots of things the politicians can do to foul it up, and I'm sure they will, they always have. I know we will have a financial crisis, and if the politicians get it wrong, we may get an economic collapse as well. What is going to trigger the financial collapse? The trade figures will start getting worse again, and this will eventually precipitate another dollar crisis. What do you see as the main cause of the trade deficit? The budget deficit, by and large, causes the trade deficit. You are not going to get rid of the trade deficit until you get rid of the budget deficit. Given the magnitude of the deficit problem, is there anything that can be done at this point? The basic problem in the world today is that America is consuming more than it is saving. You need to do everything you can to encourage saving and investment, eliminate taxation of savings, the capital gains tax, and dual taxation of dividends, bring back the more attractive incentives for IRAs, KIABs, and 401ks. At the same time, you need to do everything you can to discourage consumption. Change our tax structure to utilize a value-added tax which taxes consumption rather than saving and investing. Cut government spending dramatically, and there are lots of ways of doing it without hurting the economy too badly. We would have problems, but the problems would not be nearly as bad as when they are forced on us. If we don't bite the bullet, then we are going to have a 1930s type collapse. Your answer implies that there are relatively painless ways to cut government spending 112 dramatically. Could you provide some specific examples? I'll give you 2 examples. I could give you a dozen. The U.S. government spends $5 billion a year to support the domestic price of sugar so that Americans can pay 22 cents a pound wholesale, when it is selling for 8 cents a pound in the world market. $5 billion. We would be better off if the government told every sugar grower, "We'll give you $100,000 a year for the rest of your life, a condominium and a Porsche if you just get out of the sugar business." We would save billions of dollars a year, and the whole country would be better off because we would all be paying less for sugar. If you really want to save a big number, do you know what our annual balance of trade deficit is? $150 billion. Do you know what it costs us each year to keep American troops stationed in Europe? $150 billion. American troops were sent there as an army of occupation 43 years ago. Most people in this country weren't even born when the decision was made to send our troops to Europe. They are doing nothing there but sitting around, drinking beer, getting fat, and chasing girls. The GAO has said that we don't have enough bullets to fight even a 30-day war in Europe. Yet it costs us $150 billion a year to keep those guys there. I would submit to you that if we stop spending that $150 billion a year and bring those troops home, the Europeans would defend themselves. And the kicker is, do you know who they would buy their guns from? They would buy their guns from us, because they don't have a very good defense industry establishment. But those are very unlikely actions. No politicians are even talking about those solutions. I understand that. With the present cast of jerks in Washington, it is not going to happen. The politicians are going to foul things up. They are not going to do what has to be done. They are going to be more concerned about keeping their votes and winning the next election. That is going to continue until we are forced into solving our problems. Then it is going to be a disaster. If the politicians don't act, do we eventually face a choice between very high inflation or a deep recession? It is going to be an extreme. What I suspect will happen, and I am just speculating, I don't have to make this decision yet, is that somewhere along the line a recession will develop. Initially, the politicians will say, "We've got to bite the bullet and suffer through this. This is good for us. It will help clean out our system. People are going to buy that for a while. Then it is going to start to hurt. Then it is really going to start to hurt. At that point, The politicians are going to give up, and they are going to start to inflate their way out of it. But the only way to inflate your way out at that point is to really print money. In that scenario, we start off with a recession and end up with very high inflation. Right, but we could have wild inflation first and then deflation. Another very real possibility is that we will eventually have exchange controls. Fortunately, I don't have to make my investment decisions for 2 or 3 years forward right now. What kind of exchange controls? By exchange controls, I mean limitations on capital flows. If you want to go to Europe, you can't take more than $1,000. You can't ship money out of the country without the government's approval. What happens to the relative values of currencies in a situation like that? The dollar disappears. What would bring on exchange controls is the dollar getting weaker and weaker. The politicians would then try to bring in draconian exchange controls, which would just make the situation worse. When you say disappear, are you talking about the dollar becoming like the Argentine peso? Why not? Why couldn't it happen? Remember the Civil War expression, I don't give a damn about a greenback dollar. You talk about the collapse of the dollar as if it's an inevitability. In 1983, we were the largest creditor nation in the world. In 1985, we became a debtor nation for the first time since 1914. By the end of 1987, our foreign debts were greater than all of the foreign debts of every nation south of the Rio Grande put together: Brazil, Mexico, Peru, Argentina, and all the rest. Can I paraphrase the chain of events? You imply as follows: nothing meaningful will be done to change the budget deficit situation. The continued budget deficit will guarantee that the trade deficit situation stays bad or even gets worse. That, in turn, guarantees that sooner or later the dollar will come under extreme pressure. Absolutely. That's why I'm not long the dollar. How does the bond market fit into this scenario? At some point, foreigners are going to stop putting money into this country because of the weakening dollar. That means the American public will have to finance the debt. We have only a 3 to 4% savings rate. To get the American public to finance that debt, interest rates would have to be very high. If the Federal Reserve tries to avoid high rates by printing more money, then the dollar just disappears and the Fed loses control completely. That is the case where you get hyperinflation and 25 to 30% interest rates. Either way, we are going to have high rates. You might start out with lower rates first if the politicians decide to bite the bullet by having a recession. But then they will eventually give up and start printing money. But sooner or later, the bond market collapses. Absolutely. Sooner or later, we repeat the English experience of not having a long-term bond market. But I don't know when sooner or later is. It could be 3 years, it could be 10. How far did British bonds fall in the situation you are referring to? About 70%. 113. What kind of things do you look at in deciding which scenario will happen first? Deflation or inflation? Money supply, government deficits, trade deficits, inflation figures, the financial markets, and government policy. I look at all those things for the U.S. and key foreign countries as well. It is one big three-dimensional puzzle. However, if you had a three-dimensional puzzle, you could eventually put it together. But this puzzle is not one in which you can spread out the pieces on a great big table and put them all together. The picture is always changing. Every day some pieces get taken away and others get thrown in. While we are on the topic of scenarios, do you have a long-term outlook for gold? In 1934, they set the price of gold at $35 an ounce, and gold production declined every year between 1935 and 1980. Production kept going down because there was no incentive to look for gold. During that whole 45-year period, the consumption of gold kept going up, especially during the 1960s and 1970s when we had the electronic revolution. Demand got bigger and bigger, while at the same time the supply was going down. You would have had a great bull market in gold in the 1970s, no matter what. Even if inflation was at 0%, you still would have had a big bull market in gold during the 1970s because of supply and demand. The situation has changed entirely in the 1980s. There is nothing like taking the price of gold from $35 to $875 to make people go into the gold business. Gold production has gone up every year since 1980. Just based on known projections for mine openings and expansions, gold production is scheduled to go up every year until at least 1995. At the same time, there have been major technological advances in the recovery processes for gold. In short, there is much more gold available than there used to be, and that trend will continue at least into the mid-1990s. I own some gold as an insurance policy, but I don't think gold is going to be the great inflation hedge of the 1990s that it was in the 1970s, because supply and demand is so different. I don't know what the inflation hedge of the 1990s will be yet, but fortunately I don't have to decide today. The supply-demand picture you are painting for gold is obviously negative. But if you put that together with a situation in which, using your own words, the dollar disappears, wouldn't such an event swamp the internal supply-demand balance of gold? Certainly, gold may keep its purchasing power. It may do better, it may do worse, but it's not going to be the best market. In other words, gold was yesterday's inflation hedge. Generals always fight the last war. Portfolio managers always invest in the last bull market. The idea that gold has always been the great store of value is absurd. There have been many times in history when gold has lost purchasing power, sometimes for decades. I should add something else about gold. Remember the three-dimensional puzzle I was talking about, where there are always pieces being removed and added. Don't forget South Africa in that puzzle. Gold is more complicated because of the South African situation. I fully expect South Africa to eventually blow up, because I think that the government has painted itself too far into a corner. If there were a revolution tomorrow and the blacks took over, the South African whites would dump all their gold. So the price would actually go down a lot. In a situation like that, I would think the price of gold would go up sharply, because of the panic related to disruptions in mine production. While the revolution is going on, the price will go up, but after that it will go down. The move down will completely confuse everybody. They will ask, why is the price of gold moving down? But you will want to buy it after that move down, because the euphoria of the revolution will also bring chaos. We have talked about your long-term views for the stock market, bonds, currencies, and gold. Any thoughts about oil? Yes, when the recession hits, and I guarantee it will someday, the price of oil is going to go way down. You can put that in writing. I don't mind saying that. It certainly is going to go under $12. Whether that is $11 or $7 or $31, don't know. The price of oil was approximately $16 at the time of this interview. Given the general scenario you are talking about, the stock market going down, the dollar going down, etc., is there anything that the average guy can do to protect himself? Buy European and Far Eastern currencies, buy treasury bills, buy farmland. How did you first get interested in trading investing? I stumbled onto Wall Street. In 19,641 had just finished college and was going on to graduate school. I got a summer job through a guy I met who happened to work for a Wall Street firm. I didn't know anything about Wall Street at the time. I didn't know the difference between stocks and bonds. I didn't even know that there was a difference between stocks and bonds. All I knew about Wall Street was that it was somewhere in New York, and something unpleasant had happened there in 1929. After that summer I went to Oxford during 1964-1966. Whereas all the Americans I knew at Oxford were interested in politics, I was more interested in reading the Financial Times. Were you trading while you were at Oxford? Very lightly. I was an odd letter. The money I was investing in the market was my scholarship money at Oxford. I would get my scholarship money at the beginning of the year and invest as long as I could. Not exactly deep pockets. He laughs. If I had lost much money in either of those 2 years, so you actually started making money right off the bat? Yes, I was making money. That was the bull market of 1964-1965. By the time I left Oxford in the summer of 1966, the bear market had started, but I had already paid off my bills. I was lucky. If I had gone to Oxford during 114 minus 19,671, probably would have gotten wiped out. What happened after Oxford? I was in the army for a couple of years, and since I didn't have any money, I couldn't follow the market. In 1968, the day I got out of the army, I went to work on Wall Street. I invested everything I could. My first wife used to say, "We need a TV." I said, "What do we need a TV for? Let's put the money in the market, and we could have 10 TVs. She said, "We need a sofa." I said, "We could have 10 sofas if we just put the money in the market for a little while." What kind of job did you get on Wall Street, junior analyst? Covering what stocks, machine tools, and then advertising agencies. Were you investing in the stocks you were covering? I invested in anything. Successfully I came into the market on August 11,968, right at the top. But I still had some money left, and in January 19,700 one figured out it was going to be a bear market. I don't know how I figured it out. As I mentioned earlier, I took all the money I had and bought puts. By May I had tripled my money. In July I started shorting stocks, and by September I was wiped out. Those first 2 years were great. I went from being a genius to a fool. So you were back to ground zero in September 1970. What happened then? I saved everything I had and put it back into the market. I didn't care about a TV or a sofa. The wife got rid of me. I was the entrepreneurial spirit personified. Just like those guys who build up great retail chains and plow everything back into their stores, I was plowing everything back into the market. Were you trading just stocks at this time? Bonds, stocks, currencies, commodities. When did you get involved in these different markets? I traded all of them almost from the very beginning. Bonds and stocks from day one. Currencies fairly early too. When I was at Oxford, I kept as much money in dollars as I could, because I knew they were going to devalue sterling any day. I knew it was coming, and it did a year after I left. Once again, I was a little early. Even then, I had a strong awareness of currencies. In the late 1960s, I also got involved in commodities by buying gold. In my early years in the business, I remember interviewing for a job. The fellow asked me, "What do you read in the Wall Street Journal?" I said, "One of the first things I read is the commodity page." The guy was stunned, because he did too. This was back before commodities were commodities. He offered me a job, and when I turned him down, he almost strangled me. This job interview was in 1970, and I was already trading commodities. Going from ground zero in September 1970. Where did you start picking up trading-wise to build up to your ultimate trading success? My early losses taught me a lot. Since then I don't like to say this kind of thing. I have made very few mistakes. I learned quickly not to do anything unless you know what you are doing. I learned that it is better to do nothing and wait until you get a concept so right and a price so right that even if you are wrong, it is not going to hurt you. Did you have a losing year after that point? No. How did the quantum fund get started? George Soros was the senior partner and I was the junior partner. We started off with one senior partner, one junior partner, and one secretary. How did you know George Soros in 1970? I went to work for him and am holding an S. Bleichroder. We left in 1973 because new brokerage firm regulations did not allow you to get a percentage of the trading profits. We could have stayed, but we couldn't have managed money. So we had to leave, fortunately. We left and started our own firm. What kind of trading did you do for the quantum fund? As I understand it, that fund was managed differently from the typical fund. We invested in stocks, bonds, currencies, commodities, everything long and short all over the world. Did you and George make independent trading decisions? No. If you broke down the division of labor, he was the trader and I was the analyst. Did you come up with the idea, for example, shorting the dollar, and did he decide the timing of when to do it? Yes, sort of. What if you disagreed on a market? Usually, if we disagreed, we just did nothing. So you both had to agree on a trade to do it. There were no rules. Sometimes we would disagree and do the trade anyway, because one of us felt more strongly. But that type of scenario rarely came up, since we were usually in agreement, and once we worked things 115 through, it was pretty clear that the trade was either right or wrong. When we thought something through, a consensus was formed. I hate to use that word, because consensus investing is a disaster, but we almost always seemed to come together. When you were trading leveraged products such as commodities and currencies, how did you determine what your allocation was until we ran out of money? We were always leveraged to the hilt. When we bought something and ran out of money, we would look at the portfolio and push out whatever appeared to be the least attractive item at that point. For example, if you wanted to buy corn and ran out of money, you either had to stop buying corn or sell something else. It was an amoebic process. You know how amoebas grow? They grow out this way. Then they run into pressure, so they grow out the other way. It was a very amoebic portfolio. You never evaluated the risk of your positions on an individual basis, so if you lost money in one market and had to reduce your portfolio, you might just as easily cut back in another market, right? We would always cut back on what we thought were the least attractive positions in the portfolio. Even today, that sounds like a very unconventional fund. Back then, I imagine it was probably unique in terms of its investment strategy. It certainly was unique. I still don't know anybody who trades all the markets. By all the markets, I mean all the currencies, commodities, bonds, and stocks long and short all over the world. I am retired now, and I still do all these markets. People say to me, "You're retired, we have a full staff and can't even keep up with all these markets." What do you mean you are retired? You are short stocks all over the world. I must admit, I find it amusing when you say you are retired. Now in my retirement, I'm more active than anybody, and people say, "How do you follow all these things?" I have the same question. I don't see how you can invest in American steel without understanding what is going on in Malaysian palm oil. As I explained before, it is all part of a big, three-dimensional puzzle that is always changing. How do you find enough time to spend on all those markets? Just the reading itself seems to be a monumental chore. I do not do it nearly as actively as I used to. Over the years, I have spent a great deal of time pouring a lot of stuff into my head. I have developed a great deal of perspective on many markets. When I teach, students are always astonished by the range of historical markets that I am familiar with. I know about these markets because I have pored over many commodity, bond, and stock books so many times for so many years. As an example, I knew about the great bull market in cotton in 1861, when cotton went from cent to $1.05. How do you find out about a market like that? I start by finding the anomalous years in a long-term historical chart. When I see a picture like the 1861 cotton market, I ask myself, what caused that? Why did that happen? Then I try to figure it out. From that, you learn an enormous amount. In fact, one of the courses I teach at Columbia, which the kids call Bulls and Bears, requires each student to find a major historical market move. It doesn't matter which market or whether the move was up or down. My instructions are for them to tell me what one could have known at the time to see the big move coming. When rubber was at 2 cents, everyone said, "How can rubber ever go up?" Yet it went up 12-fold. Somebody saw it. I always ask them, what could you have seen at the time? I always nail them. They will say, I knew the market would go up because there was going to be a war. But I will make them tell me how they could have known at the time that there was a war coming. The course gives them historical perspective across a broad spectrum of markets and teaches them how to analyze. I have lived through or studied hundreds, possibly even thousands of bull and bear markets. In every bull market, whether it is IBM or Oates, the bulls always seem to come up with reasons why it must go on and on and on. I remember hearing hundreds of times, "We are going to run out of supply. This time is going to be different. Oil has to sell at $100 a barrel." Oil is not a commodity, he laughs. Gold is different from every other commodity. Well, damn, for 5,000 years it has not been different from every other commodity. There have been some periods when gold has been very bullish, and other periods when it has gone down for many years. There is nothing mystical about it. Sure, it has been a store of value, but so has wheat, corn, copper, everything. All these things have been around for thousands of years. Some are more valuable than others, but they are all commodities. They always have been, and they always will be. I guess the 1987 stock market is a prime recent example of this time is going to be different complacency. Right. There was going to be a shortage of stocks again. In 1968, one of the major Wall Street houses published a great learned thesis on why there was a shortage of stocks developing, and why the bull market had to keep going up for years right at the top. In 1987, you started hearing it all over again. There is a shortage of stocks because everybody is buying in all this stock. At the bottom of the bear market, he begins a laugh that builds steadily. There is going to be a shortage of money, I assure you, with a gigantic surplus of stocks. While editing this chapter, I came across the following item in a Time magazine story about the incredible bull market on the Tokyo Stock Exchange August 8, 1988, p. 29. One could hardly ask for a better current example of this time is going to be different. The subject of the Japanese stock market actually comes up slightly later in this interview. The explosive growth worries some Western financial experts who fear that the boom could go bust. If that happened, investors with heavy losses in Tokyo could be forced to pull money out of other markets, triggering another crash. Japanese stocks are already trading at astronomical prices in comparison with the profits of the 116 companies that issued the shares, at least by American standards. On the New York Stock Exchange, such price-earnings ratios run about 15 to 1, while in Tokyo the multiples are often 4 times as high. Nippon Telegraph and Telephone trades at 158 times its earnings. Japanese authorities have allowed a speculative bubble to grow, warns George Soros, manager of the New York City-based Quantum Fund. At no time in the past has a bubble of this magnitude been deflated in an orderly manner. Such worries are groundless, argue analysts in Tokyo. The Japanese attribute the high price-earnings ratios in part to accounting rules that allow companies to understate earnings to keep their taxes lower. Another factor propping up prices is so-called cross-holding of stock. Because many Japanese companies hold large blocks of other companies' stock, which out of tradition are seldom traded, fewer shares are available for purchase, so their prices rise. Is there a lot of similarity between different cases of market hysteria? It's always the same cycle. When a market is very low, there comes a time when some people buy it because it has become undervalued. The market starts to go up and more people buy because it is a fundamentally sound thing to do or because the charts look good. In the next stage, people buy because it has been the thing to do. My mother calls me up and says, "Buy me XYZ stock." I ask her, why? Because the stock has tripled, she answers. Finally, there comes the magical stage. People are hysterical to buy because they know that the market is going to go up forever and prices exceed any kind of rational, logical economic value. The whole process then repeats itself on the downside. The market gets tremendously overpriced and it starts to go down. More people sell because the fundamentals are turning poor. As the economics deteriorate, more and more people sell. Next, people sell just because it has been the thing to do. Everybody knows it is going to go to nothing, so they sell. Then the market reaches the hysteria stage and gets very underpriced. That's when you can buy it for a pop. But for a long-term investment, you usually have to wait a few years and let the market base. Talking about extreme bull markets, I recently read that Australia sold a acre plot in Tokyo for $450 million that they bought for $250,000 25 years ago. Is Japan the tulip mania of our day? During 1630 Forminus 1636, a speculative frenzy in tulips swept Holland, causing such an enormous rise and collapse in tulip bulb prices that the event is still famous today. I guarantee that the Japanese stock market is going to have a major collapse possibly within the next year or two. Many of our stocks are going to go down 80 to 90% in the bear market. A lot more of theirs are going to go down 80 to 90%. Is there any way the average U.S. trader can take advantage of that? Short Japanese stocks, short Japanese indexes, short Japanese calls, buy Japanese puts. A lot of Japanese stocks trade here and you can just short them. You can short the Japanese index, which trades in Singapore and Osaka. Most American brokers can do it for you. There are at least 5 major Japanese corporations which have options traded on the Chicago Board Options Exchange. Although I think a collapse is coming, you have to be very careful about going short Japan because they might change the rails on you at any time. I don't know if you remember the Kuwaiti stock market of 1980-1981. In that market, you could buy stocks with a post-dated check. You could buy $10 million worth of stocks with a post-dated check. You could buy $100 million worth of stock that way. It didn't matter. Everybody was doing it. In the end, there was a passport clerk who owned $10 billion worth of stocks, all of it on post-dated checks. Although that market was a very clear example of hysteria, I didn't short it. I thought about it that long, he saps fingers. The reason I didn't go short was because I knew when the market caved in, they would create rails so that I would never get my money out. Of course, the market eventually collapsed. If I had gone short, they would have blamed it on me and said I caused the damn thing by shorting. People were even blaming me for the October crash last year because I said it was going to happen. Some people claim I caused oil prices to collapse because I said the price of oil was going to go down. I wish I were that influential or powerful. To get back to Japan, I have a few Japanese shorts, and I'm going to have more. But whatever I do in Japan, I know when the crisis comes, I don't want to be around near the bottom, because the Japanese are going to protect themselves. And whatever they do to protect themselves, it ain't going to be good for Jim Rogers. I guarantee that. You may not be able to get your money out, yes. They could freeze the currency. They could have 3 different tiers of currency. God knows what they will do. Wouldn't you be protected if you were short a Japanese market that traded on an American exchange like the suppose they create 2 levels of currencies and the guy on the other side of the trade can't meet his obligation? The clearinghouse is responsible. Okay, fine, I'm happy to hear it. That's the best news I've had in a long time. Still, whatever I do, I'm going to be careful. If the Japanese stock market goes from 30,000 to 24,000 or 20,000, that's fine. But you better think about getting out of it before the last bit if it goes to 12,000. If you wait that long, you may get your profits out, but it is going to be very painful. Why did you leave the quantum fund? I didn't want to do the same thing for the rest of my life. I always wanted to have more than one career. When I came to New York in 19,681 was a poor boy from Alabama. By 19,791 had made more money than I knew existed in the world. Also, we were getting very big. We had started with 3 people, and by 1979 we had 15 people. They wanted to know when they could go on vacation, get raises, etc. I wasn't interested in any of that. I was interested in investing. I didn't want to get bigger. 117 in September 19,791 decided it would be my last year. But then, in October, there was a big collapse in the stock market, which we sailed right through. It was so much fun that I decided to stay on one more year. I left in 1980. Was 1980 the start of your retirement? Yes, in 19,801 just cashed in my chips and retired. Is that the point you became an independent trader? The term I really prefer is unemployed. Well, you teach at Columbia. That's unemployed. I did it as a part-time thing starting in 1983 so that I could play squash. I thought it was the love of teaching. It has developed into much more. But when I started out, I didn't even want to teach. I just wanted to learn how to play squash. You're not being facetious. You actually started teaching so you could play squash. I'm dead serious. Columbia is right here, and the dean kept pestering me to teach a course. I told him I don't think people should go to business school. I thought that for many people, business school was a waste of time. I still think so. But one thing I wanted to learn in my retirement was how to play squash. So I made a deal with the dean to teach one course per semester for free in return for lifetime access to the Columbia gym. He agreed. I thought I got a great deal, but he was smarter than I was. I'm still teaching. I take it at this point you really enjoy it. Oh, it's good fun, yes. And Columbia is terrific. What courses are you teaching? Security analysis, investment analysis, and the bulls and bears course we talked about before. Of the multitude of your trading experiences, do any stand out as particularly dramatic lots? My October 19 birthday present that I talked about earlier was probably the best. August 1982 is another. I put a gigantic part of my net worth into bonds throughout 1981 and 1982, and in August 1982 they skyrocketed. Any negative dramatic experiences? August 1971 was a very exciting time. We were long Japan and short America, and one Sunday night Nixon announced that he was taking America off the gold standard. I didn't even know it had happened. I had been off somewhere on my motorcycle and I came in Monday morning without having read the papers. That week the Japanese stock market went down 20% and the U.S. stock market went up. We were losing heavily on both sides. Did you have to liquidate your positions right off the bat? You can't liquidate at a time like that. Who can you sell to in Japan? Who could you buy from in the U.S.? If you covered your shorts, you made things worse. In a situation like that, you have to figure out whether you are right or wrong. If there was going to be a major fundamental change forever, the first loss is the best loss. But if fundamentally you are basically correct, then you do nothing but sit there and let the market hysteria wash around you. Did you stay with your positions? Yes. So you really had to ride out a rather treacherous paper loss. There is no such thing as a paper loss. A paper loss is a very real loss. What was the analysis that gave you the confidence to stay with your positions? Our analysis was that this was not the end of the world. America had simply taken a short-term step, and it was not going to solve our country's long-term problems. Did that position actually turn out to be okay? It turned out fine. The Nixon announcement was just another step in the dissolution of the Bretton Woods Agreement, a 1944 international pact that, among other things, established guidelines for foreign exchange rate stabilization and the decline of America. America was rallying in its own bear market. So you saw it as a cosmetic move that wasn't going to change the trend, and you stayed with your position. Right. Is that a general principle when government measures are implemented to counteract a trend? You should sell the rally after the government action? Absolutely. It should be written down as an axiom that you always invest against the central banks. When the central banks try to prop up a currency, go the other way. What is the biggest public fallacy regarding market behavior? That the market is always right. The market is nearly always wrong. I can assure you of that. What else? Never, ever follow conventional wisdom in the market. You have to learn to go counter to the markets. You 118 have to learn how to think for yourself to be able to see that the emperor has no clothes. Most people can't do it. Most people want to follow a trend. The trend is your friend. Maybe that is valid for a few minutes in Chicago, but for the most part, following what everyone else is doing is rarely a way to get rich. You may make money that way for a while, but keeping it is very hard. But actually, your whole style of trading involves staying with a trend for years. So isn't what you are saying contradictory? That kind of trend that is economically justified is different. You have to see the supply-demand balance change early, and only by markets that are going to go on for years. By trend following, I meant buying a market just because it goes up and selling it just because it goes down. What trading rules do you live by? Look for hysteria to see if you shouldn't go the opposite way, but don't go the opposite way until you have fully examined the situation. Also, remember that the world is always changing. Be aware of change. Buy change. You should be willing to buy or sell anything. So many people say, I could never buy that kind of stock. I could never buy utilities. I could never play commodities. You should be flexible and alert to investing in anything. If you were counseling the average investor, what would you tell him? Don't do anything until you know what you are doing. If you make 50% 2 years in a row and then lose 50% in the third year, you would actually be worse off than if you just put your money in a money market fund. Wait for something to come along that you know is right. Then take your profit, put it back in the money market fund, and just wait again. You will come out way ahead of everybody else. Are you ever wrong on a major position play? That is, are one of your almost sure shots ever wrong? Or are they so well selected that they just invariably go, I don't want to make it sound like I don't know how to lose money, because I know how to lose money better than most people, but there has not been a major mistake in a long time. But you have to remember that I don't trade that often. It is not as though I'm making 3 decisions a month. I may make 3 decisions a year or 5 decisions a year, and I'll stay with them. How often do you make a trade? Well, there is a difference between making a trade and deciding to buy bonds in 1981. I've owned bonds since 1981, but I sell around the position. I make trades, but basically I own them. I went short the dollar at the end of 1984. Now, I have made a fair amount of trades in currencies since the end of 1984, but it is basically one trade with a lot of trades around it. Very few investors or traders are as successful as you have been over time. What makes you different? I don't play. I just don't play. I can understand that. But still, very few people can analyze the same fundamentals you are looking at and so consistently be correct in assessing all the variables. Just don't do anything until you know you've got it right. As an example, until you see American agriculture hit a low, then no matter what happens in the world, unless the world is going to stop eating you, can't go wrong. American agriculture is now so competitive and so many marginal farmers have been washed out that it has to go up. You just watch American agriculture deteriorate, 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 and then you buy. You may buy early or late. In my case, usually a little bit early. But so what? The worst that happens is you bought it too early. Who cares? Is there anything else besides the fact that you are very selective that sets you apart? I have no boundaries. I am totally flexible. I am open to everything, and I pursue everything. I have no more compunction about speculating in Singapore dollars or shorting Malaysian palm oil than I do about buying General Motors. What happens when you have one scenario for currencies, one for the stock market, one for the bond market, and not everything meshes? Then I won't do anything. It happens all the time. I don't do anything until all the pieces fit. What is your opinion about chart reading? I haven't met a rich technician, excluding, of course, technicians who sell their technical services and make a lot of money. Do you use charts yourself? Yes. I look at them every week. I use them for knowledge, to see what is going on. I learn a lot about what is going on in the world by looking at charts. But you don't ever look at charts and say, I've seen this type of pattern before and it usually means the market is topping. I look at charts to see what has happened, not what will happen, what has happened. If you don't know what has happened, you'll never know what is going to happen. The charts say to me that there is a runaway bull market. They give me facts, but that's it. I don't say, what is that term you used earlier? Reversal. There is a reversal here. I don't even know what a reversal is. A reversal simply is don't tell me. It might mess up my mind. I don't know about those things, and I don't want to know. 119. Do the markets behave any differently now because so much money is being managed by trend-oriented systems? No. They may not always have been on a computer, but there always have been systems. I guarantee that you can go back 100 years in the market and not find a single decade where there hasn't been some kind of system, some kind of new formula developed to play the markets. So the markets today are basically the same as the markets in the 1970s, 1960s, and 1950s, the same as the markets in the 19th century. The same things make markets go up and down. They have not changed the rules of supply and demand. Do you have any goals at this point? I'm looking for adventure. I'd like to be able to wean myself more and more from the markets. There are 2 problems. First, investing is such a wonderful pastime that it is hard to give up. I haven't changed from when I was 22 years old. I always wanted to read and know everything that was going on and figure out the future. The second problem is, what do I do with my funds if I just stop? If I turn it over to my friendly broker at XYZ, I would be broke in 5 years, and then I would have to go back to work. Any last words? Good investing is really just common sense. But it is astonishing how few people have common sense, how many people can look at the exact same scenario, the exact same facts, and not see what is going to happen. 90% of them will focus on the same thing, but the good investor or trader, to use your term, will see something else. The ability to get away from conventional wisdom is not very common. Jim Rogers' unique approach may be difficult to emulate in its entirety, but many of his trading principles are of great relevance to all traders. His basic concepts are: 1. Buy value. If you buy value, you will not lose much even if your timing is wrong. 2. Wait for a catalyst. Bottoming markets can go nowhere for very long periods of time. To avoid tying up your money in a dead market, wait until there is a catalyst to change the market direction. 3. Sell hysteria. This principle is sound, but its application is far from easy. Rogers' methodology can be paraphrased as follows: wait for hysteria, examine to see whether the market is wrong, go against the hysteria. If fundamentally validated, be sure you are right, and then hold on tight. The tricky parts are the last two steps. Very few traders have Rogers' analytical skills and intuitive insights to wade through the maze of facts and statistics in the three-dimensional puzzle of world markets and arrive at the correct long-term projections with uncanny high accuracy. Without this type of accuracy, the ability to sit tight could be a lethal virtue. And even if you can predict long-term economic trends with a sufficient degree of accuracy, there still remains the problem of being able to sit tight, particularly when the financial steamroller of market hysteria is running counter to your position. For example, I doubt many traders would have been able to sell gold at $675, stay short while it surged to $875 in only 4 days, and then hold the position through the subsequent long-term collapse, eventually liquidating at a large profit. Even if you have the steel nerves necessary to duplicate this feat, you probably lack the financial resources to outstay this type of market, or the same high degree of accuracy in picking your shots. Perhaps this particular concept should come with a caution label attached: warning. Any attempts by the unskilled practitioner to apply the method described herein can lead to financial ruin. 4. Be very selective. Wait for the right trade to come along. Never trade for trading's sake. Have the patience to sit on your money until the high probability trade sets up exactly right. 5. Be flexible. Biases against certain markets or types of trades limit your field of opportunity. A trader who says, "I will never go short," has a distinct disadvantage compared to the trader who is willing to go short as well as long. The trader who is open to examining a broad range of markets has a distinct advantage over someone who is willing to participate in only one market. 6. Never follow conventional wisdom. Keep this principle in mind, and you will be less likely to buy stocks after the Dow has already moved from 1,000 to 2,600, and everyone is convinced that there is a shortage of stocks. 7. Know when to hold and when to liquidate a losing position. If you believe the market is going against you because your original analysis was flawed, such as when you realize you overlooked an important fundamental factor, then, as Rogers states, the first loss is the best loss. However, if the market is going against you, but you are convinced your original analysis was right, then sit out the hysteria. As a cautionary word, this latter condition should be applied only by traders who fully understand the risks involved. 121 Mark Weinstein, high percentage trader after a brief period as a real estate broker. Mark Weinstein became a full-time trader. His start in trading was so naive that he virtually threw his money away. After that early failure, Weinstein withdrew to seriously study the markets and earn another trading stake. With the exception of one disastrous trading experience, Weinstein was a successful trader from that point on. He has intensively traded a wide variety of markets, including stocks, stock options, stock index futures, currencies, and commodities. Although he is reluctant to divulge specific details, it is clear that he has profited handsomely in all these trading arenas. I met Mark Weinstein through a mutual friend. Although he was very intrigued by the project, his desire for anonymity made him reluctant to tell his story. He would call me and say, "Okay, I will do it. Let's schedule the interview." Then the next day he would call and say, "I changed my mind. I don't want the publicity." This pattern was repeated several times, with each decision accompanied by lengthy phone conversations regarding the merits and drawbacks of doing the interview. Finally, in exasperation, I said, "Mark, we could have done 3 interviews in the time we have spent talking about it." That was our last conversation regarding the matter until about 2 months later when, impressed by the caliber of traders who had agreed to participate in this book, Weinstein decided to do the interview. Weinstein met me at my office one summer evening. Because the building turns off the air conditioning after 500 p.m., we were forced out into a corner lobby which, although warm, was at least less stifling. The interview was conducted over a dinner of deli sandwiches and soda. Through our phone conversations, I knew Weinstein had a strong tendency to go off in many directions in any conversation. That's how his mind works. One topic leads him to think of 5 others and their various interrelations. Dreading a mammoth editing task, I stressed to Weinstein the need for remaining focused on the specific questions. I could tell that Weinstein was making an extra effort to heed this advice. This fact notwithstanding, the interview lasted 5 hours and yielded a 200-page transcript. How did you first get involved in trading back in 1972 when I was a real estate broker? I had a friend who was a commodity broker. He and I had gone to school together. Did your friend get you interested in the markets? It didn't take much to get me interested because my father's hobby was gambling. He was very good at percentages, and I used to watch him at the crap tables. In a sense, I think being a trader is in my genes. Also, trading fascinated me because of my mathematics and science background in college and because I had a commodity broker friend who was into computer strategies. Do you remember your first trade? I remember it exactly. I opened up a commodity account with $8,400 and I went long corn based on a recommendation made by the firm's grain analyst. 3 days later I was out $7,800. Did your broker friend advise you to follow the analyst's recommendation? Yes, and he also followed it. What I didn't realize then was that the market had been rising for some time and was already overbought when I went long. It wasn't even a bad reaction. I just got in on the move too late. I didn't have enough margin to keep the position going. Also, my guts turned on me, and I didn't want to put up any more money. It sounds to me like your friend let you put on a position that was clearly out of line with any money management principles. It was one of those get-rich-quick schemes. Did you know anything about the markets at the time? Absolutely nothing. If I flipped through a chart book, it looked like a collection of TV test patterns to me. Did you have any idea of the risk involved? I knew that the chances of my winning were very slim because I didn't know what I was doing. Didn't it occur to you that you should learn something before you started? No, because I was desperate for a change. I didn't like being a real estate broker. Was the money that you invested a substantial part of your savings? At the time it was all the money I had. When did you get enough money to come back into the markets? It took me approximately 6 or 7 months. I worked 7 days a week and rented as many apartments as I could get my hands on. I also sold a few co-ops. By that time I had saved up about $24,000 once and took out $4,000 to live on and used the remaining $20,000 to open an account. Did you make any effort to learn anything about the markets in the interim? Yes. I studied the gold market, learned how to chart, and became familiar with the concept of overbought and oversold markets. I figured that if I bought a severely oversold market and left myself enough money for 2 margin calls, I couldn't lose unless something drastic happened in the economy. That was my method. But if you use that approach in a trending market, you are going to get killed. It worked in that market. I guess ignorance was bliss. What were your trading results the second time around? I did well for several years after that and managed to build a small fortune. But a lot of that was due to luck. It couldn't have all been luck. What were you doing right when you were making money 122 in relation to what I know now? There was very little that I was doing right. I think I just had good markets. In those days, commodities seemed to follow chart patterns a lot better than they do now. Very few people knew anything about technical analysis then, so the markets were much more orderly. I got a break by learning as much as I could about technical analysis at a time when it was working pretty well. Did you have a method for controlling risk? No, and I still don't. I depended on my nervous system and gut reaction. I covered positions when I did not feel right about them. Sometimes it would be after 2 days, sometimes after 2 hours. Were you spending all day trading all day and all night? I was losing friends left and right. I sat in a studio apartment with charts plastered on every wall. I probably looked like a madman to the friends I had left. So this was really a full-time endeavor. Not only an endeavor, it was an obsession. I slept with it. I dreamt about it. Sometimes I would stay up all night thinking about what I would do the next day. If I didn't need sleep, I would have done it 24 hours a day. At that point, it wasn't the money that was motivating me. I was hooked on the game, on the challenge of trying to figure out the market. Did you sometimes wake up with a feeling that you knew the gold market was going higher or anything like that? No, it had nothing to do with the direction of the market. It was just an extension of what I was doing during the day. I would take so much of it to sleep that I ended up exploring unconsciously what I had been doing consciously that day. Did you have any goals when you set out? Well, the great American dream is to make $1 million, and that was particularly true in those days. I never really had a materialistic dream until I started vacationing and traveling in Europe. When was this? How many years after you started trading? It was in the mid-1970s. I had been trading for about 3 or 4 years. Had you passed the $1 million mark by that point? Yes, and I had made enough money to be able to relax, start vacationing, and think about things I wanted to buy. At that point, I was feeling confident enough to know that I could replace the money I spent with my trading profits. I figured the next logical step was to start appreciating the money I was making. I saw a castle in the south of France that I wanted. I was particularly impressed that the castle had a moat around it, and the idea of living there appealed to me. It was on the market for only $350,000, and I figured it would take about $50,000 a year to keep it up. That doesn't sound like a lot of money for a castle. Today it is probably worth $5 million. When I came back to the U.S., I wanted to make the money to pay for the castle almost immediately. That was a tremendous mistake. I don't understand. You already had the money to buy the castle. You didn't have to make it. Even though I had the money, I still looked at it in terms of how much it cost. I know people in this business who have $17 million in their trading account and won't buy a new car. So you didn't take your money out of the account to buy the castle. No, I came back and decided that making the money was going to be my goal. In other words, your next $350,000 in profits was going to go for the castle. Exactly. What happened on my next trade, I put on a large long position in soybeans. The market closed up the first day, and I had about a 25% profit on my money. I was planning to get out of the position at the end of the week. The biggest mistake I made was having a specific target of what I wanted out of the trade, the target being determined not by market analysis, but rather by the $350,000 you wanted to make on the trade. Did you trade differently because you were trying to make money for a specific purpose? Yes. I didn't consider the risk and took on too large a position. I was not using any type of rational judgment. I was being guided by my material desires. The market went up again the next day, but collapsed suddenly late in the session, locking limit down. Did you get stuck with your position at limit down? Yes. I couldn't get out. The next day I showed up at the brokerage office and the market opened offered limit down. I waited all day to see if it would come off of locked limit down, but it didn't. I take it that you would have liquidated your position if you could have. If the market had traded, I would have sold out at any price. Do you remember your emotions at the time? I was in a state of shock and had no decision-making capability left whatsoever. I couldn't fall asleep and found myself almost praying the market would somehow trade the next day. On the third day I called the office about a half an hour before the opening, and they told me it didn't look like there was any hope. I didn't even bother 123 going in because I couldn't face the people in the office. I was certain that they were getting a big thrill out of my situation. Why is that there were a few other professional traders in the office who were never able to make the kind of money I had been making. When this situation developed, they were almost relieved. It seemed to justify all those years of their not taking positions like I did. They were really heartless. The only person who was really upset was my broker, and, frankly, that was probably because he was afraid of losing the account. Did the other traders kid you about it? They over-consoled me and then laughed about it behind my back. They wanted to see me come in and fall apart. That is why I stopped coming to the office. Do you think they relished your predicament because it made them seem less deficient as traders? It went beyond that. I think there are a lot of people in this business who just enjoy watching others lose money. Once you stopped going into the office, what did you do during the day? I checked with other brokerage houses, trying to get price quotes. Why didn't you just call your own broker? I was too embarrassed, and I didn't want to take the derision. Your own broker was kidding you. I didn't know what to think of him. I was starting to get paranoid and hostile because nothing could be done. I went to a competing firm and spoke to their grains analyst. I was looking for someone to hold my hand. He told me I would be okay, because the fundamentals were still strong and there would be a tremendous demand for soybeans if the market went down another day. Of course, on the fourth day, the market locked limit down again. How much were you losing each day? About $125,000 a day. This was at a time when the average annual salary was $15,000. 1 cent was not born rich, and I couldn't stop thinking of my loss in those terms. Could you put that loss in perspective relative to your account size before that trade? I had nearly $1.05 million in my trading account. So I was losing nearly 10% of my equity level prior to the trade each day. I was devastated. I felt like I was wounded in a trench and watching myself bleed to death. The market went limit down 5 days in a row, and I lost over $600,000. On the fifth day I remember sitting in a park holding hands with a girl I had picked up literally crying on her lap. I was practically in a psychotic state. I thought about getting out of the business altogether. I started to think that what everybody was telling me was true. Maybe it was just luck that I had made money all those years. I worried that if I continued trading, I could wind up losing it all and being forced to go back to some job I didn't like. Which was more devastating, the large monetary loss, or your feelings about going from success to failure? It was the money and the limit situation, and the fact that I couldn't act. My exact thoughts were, here I am, a person who thought it was un-American to go short, and what I found out was really un-American was not being able to get out of a position. So you felt cheated by not being able to get out. I definitely felt cheated. To this day, I think there is something wrong with limit price moves. Are you implying that price limits that were supposedly created to protect the public actually work against them by preventing people from getting out of their losing positions? Yes. I think the market should be totally free of restraints. There is talk about putting limits on stock markets as a way of reducing volatility. Would that actually be jumping from the frying pan into the fire? Absolutely. Now, the average investor knows that if he wants to get out, he can at least get out at some price. Imagine if this guy calls his broker and finds out that he can't even get out of the market. In other words, you are saying that those who are expounding the idea of limits are really going to make matters worse for the small investor. It is absolute lunacy. It is a law that is being proposed for the benefit of sophisticated institutional investors. Your earlier comment implied that prior to the soybean trade, you always traded the long side of the markets. Is that right? Yes. I never went short. I felt it was un-American. After the soybean trade, I realized that the business I was in was the height of capitalism, and it really made no difference what side of the market you were on. All I could think about was that the people who were short made money, and I lost money. How long did the emotional impact of this experience last? Months. I didn't want to trade commodities anymore. I ripped every chart off my walls. I tore up everything in my house that had anything to do with commodities. When did you begin trading again? After a few months, I started trading Amex stocks, but I found it amazingly slow. I missed the leverage of the commodity markets. I didn't think I could successfully support myself trading stocks. Around that time, I ran into a friend who is a great options trader. I told him about my experiences, and he 124 suggested that I join him. In my first week at his office, he told me to buy Teledyne calls right before expiration because he was sure they were going up. I followed his advice, and the calls completely collapsed. How much did you lose? About $40,000. One cent. Felt extremely hostile, but I didn't want to show it because he never promised me any results. I was so upset that I walked out of the office and didn't come back for 2 days. He tried reaching me during that time, but I didn't return his calls. Finally, he got a message to me through a mutual friend. Was he upset that he had given you bad advice? When I came back to the office, he told me that he had done the exact opposite trade in another account, and that the trade was mine. So I didn't really lose any money. That sounds like an awfully odd type of practical joke. It wasn't a practical joke. He was trying to teach me not to place blind trust in anyone, even him. It was his way of teaching me the importance of self-reliance in being a good trader. How did you do after that point? I did pretty well. My friend was a phenomenal options trader. He knew everything about the market, and I learned a tremendous amount from him. Did you trade options based on the methodologies he taught you? Yes, combined with my own technical analysis. Your friend didn't use technical analysis. No, he didn't believe in it. He was a tape reader. Has the fact that you have been extraordinarily successful as a 100% technical trader changed his mind about technical analysis? Not at all. He thinks technical analysis is just a crutch for me, and the real reason I make money is experience. There was a point at which we separated for a few years. He came to my office one day and watched me trade. He embraced me like a father and said, "You finally made it." I told him that not only had I gained a lot of experience, but I had learned just about everything there was about technical analysis, including certain things I had created myself. He said, "You never give up, do you? It has nothing to do with technical analysis. You are trading that way because of experience. Why did you and your option trading friend eventually separate? There was a conflict in our trading styles." He was a great trader who was willing to take an occasional large loss because he knew he would more than make up for it with large gains and come out way ahead in the long run. However, I was uncomfortable trading that way. I preferred trading for small profits and trying to eradicate losing trades. I wasn't willing to take the same type of risk. Also, my approach was purely technical, whereas he was basically a tape reader. Anyway, in 19,801 decided to go off on my own. We got together again years later. I know you once entered an options trading contest. Can you tell me about it? It was originally organized by two traders on the floor. They got 47 traders together, each of whom put up $5,000 in a winner-take-all contest. Each trader opened a $100,000 account with the same clearing firm. How long was the contest? For 3 months. What were your results? I turned the $100,000 into over $900,000 without any pyramiding, using profits to increase leverage. That's a rather phenomenal performance. Yes, but the markets were very good at that time. What did you trade when you went out on your own in 1980? I traded everything. I continued to trade stock options. When stock index futures trading began in the early 1980s, that became a primary market for me. I also traded the commodity markets. In fact, during the last 2 years, my trading has shifted to nearly 90% commodities. Do you remember your first soybean trade after the debacle in the 1970s? For a long time, I avoided soybeans. But as I began to find myself trading the commodity markets effortlessly, I knew deep down that I would eventually get back the money I lost in soybeans. I never forgot about it. It sounds like you were looking for revenge. Yes, exactly. Every time I looked at a commodity chart book, my eyes would edge over to the soybean chart. Then I would quickly flip the page. I watched the market peripherally for years before doing anything. When soybeans went down to $4.751, knew they were near a low, but I didn't want to buy them until I was sure I couldn't lose on the trade. I was like a Sicilian whose wife had been murdered 10 years earlier, waiting for the perfect moment for revenge. When my technical analysis convinced me that the market had bottomed for real, I jumped in on the long side. Where did you buy the beans? Around $6.18. This was shortly before the 1988 drought caused prices to skyrocket. Where did you get out? I got out of some at $7.25 and the rest at $9.92. The high of the move was $10.46. 125. How much did you make on that trade? Let's just say I made my money back in spades. The way you talk about it, it sounds like that trade was a great relief for you. Yes, it was a total catharsis. I realized that there was a reason why I had lost the money in the first place. What was the reason? Because I was inexperienced. I don't believe anyone ever gets wiped out in the market because of bad luck. There is always some other reason for it. Either you were off when you did the trade, or you didn't have the experience. There is always a mistake involved. You mentioned earlier that one of the reasons you split with your former trading partner was that your own trading style was geared to extremely low risk. Since 1980, What was the worst percentage drawdown you have experienced? I lose so infrequently that I don't really keep track of that type of number. Well, let's put it this way. What was your worst single trading month? I haven't had any losing months. You have made money in every single month since 1980. Yes. Of course, I could have made a lot more money if I wasn't so cautious, but that is the way I trade. Do you remember your worst losing week? I haven't had any losing weeks during that time, but I have had some losing days. That is an incredible statement. How can you be sure that you are not simply forgetting about a few weeks when you lost money trading? The reason I am sure is that I remember all my losses. For example, I have had 3 losing days in the last 2 years. Out of the thousands of trades I made during that time, I had 17 losers, but 9 of them were because my quote machine was down, and when that happens, I just get out of my position. Most traders would be happy winning on 50% of their trades, and a win ratio of 75% would be spectacular. Yet you are implying that your win ratio is somewhere in the vicinity of 99%. That is really hard to believe. You can check with Lee. I told him about hundreds of my trades during the past few years. Lee Stevens is a mutual friend who introduced me to Weinstein. Okay, reader, I know what you are saying, no losing weeks, but I've had some losing days. Give me a break. Frankly, I admit Weinstein's statements sound preposterous. I could not verify his claims by examining account statements because his partners are vigorous in maintaining the confidentiality of the partnership's trading activity, as it is a private trading firm, not open to the public. In fact, a number of his partners were adamantly opposed to this interview and were nearly successful in dissuading Weinstein from participating. The only account statement Weinstein was willing or able to show me was his independent entry in the option trading contest, which did indeed confirm that he multiplied a $100,000 account ninefold in 3 months with 100% winning trades. Still unsatisfied, I spoke to Lee, who has known Weinstein for years and has spent many days watching him trade. I have known Lee for 3 years and can confidently describe him as honest, low-key, and level-headed. Lee confirmed that of about 100 of Weinstein's trades he had personally witnessed, and several hundred more Weinstein told him about on the phone right after he put them on, he could remember only one that was a loser. Even if because of faulty memory, I mean this literally, not as a euphemism for dishonesty. Weinstein's actual percentage winning rate is somewhat lower than he implies. I still believe his win-loss ratio is incredibly high. How can he do it? Weinstein's own response to this query follows, but to put it in perspective, I thought some further elaboration would be helpful. Weinstein employs his own custom-designed state-of-the-art computer systems to monitor constantly technical indicators designed to measure changes in market momentum. Rather than use the standard values for these indicators, Weinstein uses his own values, which he frequently adjusts for changing market conditions. He combines this intensive real-time analysis with comprehensive chart analysis, incorporating a variety of methodologies, including cycles, Fibonacci retracements, and Elliott wave analysis. Finally, add to this one last essential ingredient, an uncanny sense of market timing. Only when nearly everything lines up right and he feels the timing is virtually perfect does he put on a trade. He passes up many trades that he believes have a high probability of working, but for which he lacks the same degree of near absolute confidence. Because of the combination of a lifetime devotion to studying the markets, intensive real-time analysis, innate market sense, and incredibly rigorous trade selection, virtually all of Weinstein's trades are at least marginally profitable at some point within 20 minutes of entry. That is all Weinstein needs to assure a break-even or better result. It helps to understand that Weinstein usually plays for quick profits and covers his trades within hours or even minutes. Even on position trades, Weinstein will usually take some profits quickly to assure a net profitable outcome. He also trades markets in rotation, quickly shifting his profits from market to market, always seeking the profit potential with the lowest perceived risk. Finally, Weinstein enjoys the support of a floor network that often puts him on the right side of the bid-ask spread. Weinstein's comments may sound like boasting on the written page, but that belies their tone naïve. It would be a much closer description. When Weinstein talks about trades, his comments are peppered with phrases such as, "It's obvious the market is going lower. This market is so easy." It is clear he has no conception of how difficult trading is for the rest of us. How do you explain your ability to win such a high percentage of the time? Because I have a real fear of the markets. I have found that the greatest traders are the ones who are most afraid of the markets. My fear of the markets has forced me to hone my timing with great precision. When I am 126 trading properly, it is like a pool player running racks. If my gut feel of market conditions is not right, I don't trade. My timing is a combination of experience and my nervous system. If my nervous system tells me to get out of the position, it is because the market action triggers something in my knowledge and experience that I have seen before. I also don't lose much on my trades because I wait for the exact right moment. Most people will not wait for the environment to tip itself off. They will walk into the forest when it is still dark, while I wait until it gets light. Although the cheetah is the fastest animal in the world and can catch any animal on the plains, it will wait until it is absolutely sure it can catch its prey. It may hide in the bush for a week, waiting for just the right moment. It will wait for a baby antelope, and not just any baby antelope, but preferably one that is also sick or lame. Only then, when there is no chance it can lose its prey, does it attack. That, to me, is the epitome of professional trading. When I trade at home, I often watch the sparrows in my garden. When I feed them bread, they take just a little piece at a time and fly away. They keep on flying back and forth, taking small bits of bread. They may have to make 100 stabs at a piece of bread to get what a pigeon gets at one time, but that is why a pigeon is a pigeon. You will never be able to shoot a sparrow, it is just too fast. That is the way I day trade. For example, there are times during the day when I am sure that the S&P is going up, but I don't try to pick the bottom, and I am out before it tops. I just take the mid-range where the momentum is greatest. That, to me, is trading like a sparrow eats. Am I paraphrasing you correctly? The cheetah is your analogy for position trading, and the sparrow is your analogy for day trading. The common denominator is that both animals wait for can't-lose circumstances. Exactly. How do you pick your trades? I use many different types of technical input charts, Elliott wave and Gann analysis, Fibonacci numbers, cycles, sentiment, moving averages, and various oscillators. People think that technical analysis is unreliable because they tend to pick the one thing they are comfortable with. The problem is that no single technical approach works all the time. You have to know when to use each method. How do you do that? It is experience and gut feel. I use all forms of technical analysis, but interpret them through gut feel. I do not believe in mathematical systems that always approach markets in the same way. Using myself as the system, I constantly change the input to achieve the same output profit. Is there anything you can single out as the most important element in deciding to put on a trade? I am always looking for a market that is losing momentum and then go the other way. Having traded both the stock and commodity markets, would you say they behave differently? Absolutely. In contrast to the commodity markets, the stock market very rarely gives you the opportunity to enjoy a meaningful trend. Why is that? Because when institutions and specialists sell out, They don't sell out at one price level. They scale out as the market goes up. Similarly, when they buy, they scale in as the market goes down. This leads to choppier price action and is the reason why many good commodity traders that I know lose every time they go into the stock market. But you win consistently in the stock market as well. What are you doing differently? I don't try to figure out where the market is going before the action. I let the market tell me where it is going. Also, there is such a variety of technical input in the stock market: divergence, advance decline, sentiment, put-call ratios, and so on, that you will almost always get a signal before the market is about to do something. Is your method of technical analysis therefore different in the stock market than in the commodity markets? I look at the individual stocks. They all have their own personalities. For example, IBM and General Motors will usually rally before a major market bottom and fail to rally before a major market top. As another example, I have never seen a real good rally without the utilities leading the market. The utilities go up when interest rates are expected to come down, and when interest rates come down, portfolio managers jump into stocks. I have done extremely well trading the indexes because before I ever traded index futures, I had become a very experienced trader of stocks and options. What do you think is the public's biggest misconception about the markets? That people who trade the markets gamble. I know floor traders that have made money for 20 straight years. You can't call that gambling. Another major misconception is that people always expect the market to react to news. For example, when John F. Kennedy was assassinated, the market initially broke very sharply, but then quickly rebounded to new highs. This price action baffled many people. Investors who sold on the news only to watch the market reverse blamed the institutions for pushing the market higher. What they failed to realize is that a market that is fundamentally and technically poised to move higher is not going to reverse direction because of a news item, even a dramatic one. Another item I would place under the category of misconceptions is the way the media reports the reasons for the market being down. They are always saying that the market is down because of profit taking. I think it would be wonderful if everybody was always taking profits. But the truth is most people lose money, and the reason markets go down is because they take their losses. I know educated people who watch the news and wonder why the hell they lost money when everyone else is taking profits. The media owes it to the public to report that the market goes down not only on profit taking, but on a lot of loss taking as well. What are the trading rules you live by? 1. Always do your homework. 127. 2. Don't be arrogant. When you get arrogant, you forsake risk control. The best traders are the most humble. 3. Understand your limitations. Everyone has limitations, even the best traders. 4. Be your own person. Think against the herd, as they must lose in time. Don't trade until an opportunity presents itself. Knowing when to stay out of the markets is as important as knowing when to be in them. 5. Your strategy has to be flexible enough to change when the environment changes. The mistake most people make is they keep the same strategy all the time. They say, "Damn, the market didn't behave the way I thought it would." Why should it? Life and the markets just don't work that way. 6. Don't get too complacent once you have made profits. The toughest thing in the world is holding on to profits. That is because once you have attained a goal, you then set a second goal that is usually the same as the first one to make more money. Consequently, for many people, attainment of that second goal is not as rewarding. They may begin to question what they really want from trading and trigger a self-destruct process in which they wind up losing. Any final advice you have for the beginning trader: you have to learn how to lose. It is more important than learning how to win. If you think you are always going to be a winner, when you lose, you will develop feelings of hostility and end up blaming the market instead of trying to learn why you lost. Limit losses quickly. To paraphrase from Reminiscences of a Stock Operator, most traders hold on to their losses too long because they hope the loss will not get larger. They take profits too soon because they fear the profit will diminish. Instead, traders should fear a larger loss and hope for a larger profit. Weinstein's most traumatic trading experience occurred when he let a material goal interfere with his trading. This is a common theme that has surfaced in other interviews. It invariably seems to be a mistake to translate the potential profit or loss of a trade into material terms. The cornerstone of Weinstein's trading approach is to wait for those trades in which everything appears to be lined up exactly right and the odds of winning seem overwhelming. Even though most of us can never expect to remotely approach Weinstein's confidence in the trades he selects, the concept of waiting for only those trades one feels most confident about is sound advice that is echoed by a number of traders in this book. Although viewing markets as non-random over the long run, I have long believed that very short-term market fluctuations, i.e., intraday price movements, were largely random. Weinstein has shaken this belief. 128 part Roman 4, The View from the Floor. 129 Brian Gelber, broker turned trader. Brian Gelber began his career as a broker, managing a major brokerage firm's financial futures operations on the floor of the Chicago Board of Trade. After successfully advising institutional clients, he began trading for his own account. In the early days of T-bond futures trading, Gelber enjoyed the dual distinction of being one of the most, if not the most prominent brokers on the floor and one of the largest local traders. In January 1986, Gelber expanded his trading to include the direct management of customer accounts. In addition to his own trading, Gelber supervises a group of traders in both cash and futures in government securities and other markets. He is the president of a group of companies, Gelber Group, Gelber Management, and Gelber Securities. These companies are involved in clearing, brokerage, and money management. Gelber's relaxed personality seemed almost out of place with his profession. Instead of the high level of intensity expected of someone who trades and supervises trading in multimillion-dollar bond positions daily, I found a man who talks about his work as if he were describing a pleasant vacation. Although our meeting took place during trading hours, Gelber did not seem to be overly concerned with the bond market. In fact, he seemed quite relaxed, despite leaving the trading desk for his private office to conduct our interview. "I'll probably do better by staying here," he remarked, obviously reflecting what he perceived to be a low opportunity market at the time. In response to a query regarding other traders I was interviewing, I mentioned that one, Tony Saliba, had made the cover of the current issue of Success magazine. Gelber asked me if I had a copy. I pulled out the magazine from my attaché case and handed it to him. He smiled as he read the bold headline describing Saliba's experience during the week of the October 191,987 stock market crash victory. He made $4 million in 72 hours. Jokingly, Gelber asked, "I made $4 million in 20 minutes on that day. How come I'm not on a magazine cover?" It was not meant to be boastful. It did, however, very specifically summarize a basic truth about great traders. Many, if not most, maintain relatively low profiles and are therefore virtually unknown to the public. How did you get started in this industry after graduating from college in 19,761? Backpacked around the country. In Salt Lake City, I answered an ad for a commodity broker position. I didn't have any idea what it was, but I figured it was something like a stockbroker. I got my license while working for a guy who was basically running a boiler room operation. You really started out on the wrong side of the business. When I walked in, there was a guy seated at the back end of a penny stock office. He spent his days on the phone trying to convince people to give him $5,000 or $10,000 to speculate on his charting system. It was a real fly-by-night operation. I was keeping his charts for him while getting registered. I kept saying to myself, this guy is pretty much of a crook. I got my license and quit. Then I bummed around for another few months, just working temporary jobs to pay the rent. What kind of jobs? Unloading railroad cars. Then one day I walked into a Thompson McKinnon office and said, "Hey, I have a broker's license." The fellow there said he would pay me $800 a month. That was a large amount of money for me at the time. All I had to do was go in and cold call. Any accounts I opened would be mine. But you knew virtually nothing at all about markets at that time. I had read a couple of books, and I knew something about charts, having kept them for the first fellow I worked for. What books did you read? There weren't too many around at that time. The book I learned the most from was Technical Analysis of Stock Trends by Robert D. Edwards and John Magee, Inc., 109 State Street, Boston, Ma. What other books would you recommend to people? The first book we have our traders read is Edwin Lefever's account of Jesse Livermore, Reminiscences of a Stock Operator, reprinted in 1985 from the original 1923 edition by Trader Press, Inc., Greenville, S.C. I've read it at least a dozen times. Anyway, around the time that I started at Thompson McKinnon, the Ginnie Mae market was just coming into its own. Thompson McKinnon had just hired a trading group to run a Ginnie Mae desk. I told them I was interested in learning more about the Ginnie Mae market. Why were you attracted to that market? It was a new market and seemed more manageable than the conventional commodities. I figured my business would grow more steadily if I focused on that market. Also, I had made a number of trades in Ginnie Mae's. The first trade was a winner, but the following ones were all losers. It was magnetic. I felt I could make money there, but I kept losing, and that made me want to learn more about it. It sounds like you had a minor compulsion to pursue it. Yes, because I had failed. Anyway, the traders at the Ginnie Mae desk taught me a few things, and I went out and opened almost every mortgage banker account in Salt Lake. Did you understand the Ginnie Mae market at that time when I first started opening accounts? I didn't understand anything about it. How then did you sell people on yourself? I snowballed them at first, but I listened and I learned from the questions they asked me. Initially, I was 130 confused by what they were doing, and they were equally confused by what I was trying to sell them. At least you understood futures as an instrument. Right. And with that limited knowledge, I bumbled through my first few meetings. Then I really got pretty good at it. Were these hedging accounts? Yes, all pure hedging accounts. By May 19,771 was making $2,000 a month in commissions. That was a tremendous amount of money for me. Was this all in the Ginnie Mae market at that point? Yes. Previously, I had done some brokerage in other commodity markets such as wheat, hogs, and pork bellies. Who were those trades for just accounts I had opened by cold calling people who really didn't understand that they could lose, and when they lost, they were always upset. Were you giving them trading suggestions? Pretty much. Using chart analysis, believe it or not, more off the research of Thompson McKinnon analysts and secondarily off my charts. Newer brokers definitely tend to rely on their firm's research. Did your customers lose because the research was wrong? No. They lost because their time horizon was mostly day to day, while the research was longer term. So there was a mismatch exactly. I think that is a basic problem between most brokers and their customers. It is almost impossible to get market information to your customer quickly enough for the customer to act on it. What you are saying is that even if a broker can actually beat the market trading short term, he can't translate that to the customer. Insurmountable odds, because you have two people who have to pull the trigger, and the information changes so quickly. So, one of the points of advice you would give to speculators is to trade with a longer term perspective. Yes, you have to. Let's talk about floor trading. I know, at one point, you were both a floor broker and trader in the T-bond futures market. The question I think a lot of people would ask is, if you receive a large customer sell order at the same time you're thinking of closing out your own long position, how do you handle it? I never scalped. So the idea of being long and having a large customer order move the market against me 2 or 3 ticks never made any difference. Besides, I had so many customers that they were often going opposite ways. Okay, that's an easy one. But what if some important news was breaking and all your customer orders were going one way against your own position? Did you ever end up trapped in a position because you had to execute all the customer orders first? Yes. That happened to me about half a dozen times, and it probably cost me a grand total of $500,000 over a number of years. But measured against the amount of money I was making, it didn't kill me. That was the cost of doing business right. It must be a gut-wrenching situation, though, knowing you want to get out, but not being able to act because of a conflict with customer orders. Usually you are too busy acting as a broker and thinking, okay, I have to sell 1,000 lots. How can I do it best then? When you are done with the order, you might say to yourself, oh damn, I'm still long. I have to get out of this thing. Is there a built-in disadvantage for a floor trader who also handles customer orders? Absolutely. As I tell the people I hire, if you are a broker, you are not a trader. If you are a trader, you are not a broker. But you were. It was a wild time. I was the biggest trader and the biggest broker in the same market. I worked very long hours and was totally exhausted when I went home. Then I would just get up the next day and do it again. This went on for 3 years, and while it was a great experience, I really shouldn't have done it. You can't be a great broker and a great trader. I did a good job, but it probably took years off my life. Are most of the significant size traders on the floor just traders? Or do some also handle customers? They all are either brokers or traders now. That is the only way to go. There is no doubt about it. Is that true of most floors, or just the T-bond floor primarily? The T-bond floor. In the S&P and in the New York markets, some of the big brokers are also big 131 traders. Given today's increased scrutiny, are people who violate the confidence of dual trading handling customer orders and trading one's own account likely to get caught? It is still very difficult to create a flawless audit trail in an open outcry market. Say bonds are trading at 95.0 and the market gets hit with some bearish news. The broker executes a large amount of orders for customers and his own account, and the market goes straight from 95.0 to 94.0. His tills are 94.31, 94.30, 94.29, and all his customers get fills at 94.27 or lower. Bond prices trade in 30 seconds. How does he explain his way out of that one? He could give his order or his customer's orders to another broker. Or he could fill both orders and put another broker's number on his own order. There are always ways to get around extra scrutiny. The smart crooks will always be difficult to catch. Is the temptation in dual trading too great? No. After having been through it, I would say that dual trading is good for efficiency in the marketplace, but it is too heavy a burden for the individual. Should the rules be changed to disallow dual trading? That is a difficult question. What is more important? The efficiency of the market or the integrity of the individual? There is no doubt in my mind that dual trading adds tremendous liquidity to the system, and that is probably more important than the fact that a small percentage of dual traders may cheat. Besides, even if dual trading were banned, the stealers would still find a way to steal. That is their perception of how to make money in this business. When did you first get involved in the T-bond market? High September 19,771 moved to Chicago and became a broker on the T-bond floor. I was just 25 and I got lucky. I went to New York in November 1977 and met with 8 big-name companies, 7 of whom opened accounts. I was at the right place at the right time. When did you start trading for your own account on the floor in 1979? Were you tempted to give up your floor brokerage so that you could concentrate on trading actually? It was just the opposite. I had started out as a customer's man, and from 1979 through 19,811 built a massive customer base. We were a powerful force in the market at that time. Probably the saddest thing I ever did was to become a trader too. I was a great broker in my 20s, and if I had parlayed that for 10 years, I probably would have ended up where I am now without enduring all the pains of trading. I consider trading to be an unrewarding, unglamorous game. It's odd you say that because you have been far more successful than most traders. I guess my point is that as a broker I was at an even higher echelon. I was really good at it, and it suited my personality. So, why did you get into trading? I started trading because some of my customers said, "You know the market so well. Why don't you just trade?" I resisted at first, but after 6 months of holding out, I started trading. From there it just evolved. Do you remember your first trades? My first trade was a long position, and I made some money. Then I put on a long bond short Ginnie Mae spread, which was almost like being long. The market went down, and I lost all the money I had made, plus $50,000 more. Since I was making about $50,000 per month as a broker, my attitude was that I basically broke even that month. But I didn't like the feeling at all. So I cut my position size down and started trading a little more actively. This happened during the bear market of 1979. The problem was that I was bullish all the way down. Why were you bullish? My customers kept telling me that rates couldn't go much higher. For example, I was handling the orders for Citibank and Citicorp, and they were buying all the way down. These were renowned people saying that they had an opinion and backing it up with deeds. Bond prices fall when interest rates rise. This is a basic concept that is sometimes confusing to the novice. The reason that bond prices decline if rates increase can be explained as follows. If rates rise, it means that all existing lower yielding instruments are less attractive to investors. To induce an investor to purchase these lower coupon bonds, their prices must fall sufficiently so that the return is equivalent to the return on the higher coupon bond purchased at face value. What would you do today in the same situation now? I know the characteristics of various institutions. Let's take Citibank. Back then, I was buying because they were buying. Now, if Citibank was buying, I might conclude that they were just reallocating their assets or changing the duration of their portfolio. Today, I have little regard for the views of portfolio managers because their outlook tends to cover a much longer time perspective than mine. I didn't understand that back then. So, you don't pay much attention to those types of opinions anymore. I listen to them in passing. I don't read the Barron's interviews of portfolio managers anymore. It never did much for me, and I don't think it does much for any trader. In other words, the problem wasn't the fact that you were listening to other people, but that you 132 were listening to the wrong people. I didn't know how to decide which were the right or wrong people. I was a naive kid saying, "Here is a major account.